This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My combo episode today reaches back into my back catalog and pulls forward 4 classic episodes from this podcast, aggregated into one new modern podcast. 4 names that if you are into trading and you don't know, you're not really into trading. Perhaps you're brain dead. Now, I should not be that mean. Oh, hell, I am that mean sometimes. What the heck, right? Whatever. The 4 names: Jack Schwager, Peter Brandt, Larry Williams, Toby Crable. If they don't mean something to you, you have not worked very hard. You've not studied much. You've not read much. Perhaps you just watch CNBC and drool a lot. I don't know what your problem is. But these 4 guys are very experienced. They are the pros. Learn from them. Go read their books. Find everything you can find that they have said. And if you're not smarter, well, then retire, because you can't do this. Just forget it. Okay, let me calm down for a second and give one PSA, one public service announcement. I want to thank this audience for recently pushing my Turtle Trader book into the top 1,000 of all books on Amazon. How that happened exactly, I have no idea. But when I see my book in the middle of titles from Michael Lewis and Nassim Taleb, I really say to myself, how did a guy that never got above a C in English in college get a book there? That is so cool. So thank you very much. And a quick reminder on that Turtle book. The audiobook came out last year, and there is a special interview in the Complete Turtle Trader audiobook with Jerry Parker, the most successful turtle, and it's only on the audiobook. Check that out. Also, for those of you that have not yet seen, and I need to make a video of this, but my newest edition of Trend Following, the hardcover from Wiley, April 2017, you must check this out. This is a really nice one to put on the shelf or give away as a gift. If you gave my new Trend Following away as a gift, I guarantee you, even if people don't want to read about trading, they're going to go, wow, this is a cool book, and they're going to put it on a shelf somewhere. Okay, enough of me trying to get you to buy my really cool books. And on to these 4 great guests: Jack Schwager, Peter Brandt, Larry Williams, Toby Crable, all combined into one magnificent, aggregated, fantastic, over-the-top episode. Well, maybe it's not going to be over the top, but it will be informative as hell. I promise you that. Jumping in first, without further ado, Jack Schwager. When I think back to my start of trying to get inside the mind of really good traders, in the early 90s, there was only really one place to start. And I remember picking up the book Market Wizards and reading it and thinking, I understand about half of this. Like it was deceptively dense. And I'm sure a lot of people can still go back and read Market Wizards and New Market Wizards and still not understand all the details, because it's right there in front of you, but sometimes it's hard to get your arms around. With that, and I don't think I'm the only person, I think that those books really affected an entire generation. I mean, those are still today, if you haven't read them, and you want to try and make money in the markets, what's wrong with you? That's my question. So I'm lucky today to talk to the gentleman that wrote those books, Jack Schwager. And Jack has a new book out that I think anybody that liked the Market Wizards and like the New Market Wizards and like Stock Market Wizards, this one's called Hedge Fund Market Wizards. You're going to like it. I read it over the weekend. It raises all kinds of questions. It gets you thinking in the right way. And anyways, Jack, thank you for being here on the show today.
Hey, Mike, thanks for the introduction. Appreciate it.
Well, before we even get into some of the content and some of the specifics here, I think a lot of people would like to know, like, what makes Jack get up every morning? What makes you tick? Like, what's your daily grind?
Not terribly exciting. I kind of have a routine, no set routine to speak of. It depends what I'm doing at the time. So last couple of years, it was basically changed. I deliberately left my last day job and wanted to take some time to write a couple of books. The first one of which was Hedge Fund Market Wizards, and the other one which I just completed. So my grind is just varied from day to day. I'd write whenever I felt it was working, which was most of the time, I guess. And I take time breaks whenever I wanted to, whether it's take a walk or to do something else, but nothing terribly exciting.
Well, but you've built the life that you've wanted.
Yeah, what I basically have done for quite a number of, even my day job was a day job run from a home office and sort of working in conjunction with a London-based company. And even now, my other endeavor will be to be managing a portfolio, again, working as a consultant, not as a daytime job. So I've kind of managed to be working full time and be retired at the same time. So it works pretty well.
I think that's the dream everybody wants. That sounds that's the way to approach it. Well, let me get into your new work, because I think this is what people really want to know about. And for any of you folks out there that have looked at Jack's first three books, especially the first and second one, this book has got. This isn't a book of just semi good names in the trading space. It's like the guys. I mean, these are the people today in 2012 that are kicking royal tail on the markets are in Jack's new book. So as a fellow author who is in this space, I have to, there's a certain side of jealousy, of course, that these great interviews. But the thing that caught my eye, because I actually saw this interview on 60 Minutes. And so when I saw it in your book, Jack, I thought it was great. And I just want to kind of repeat this quote for a second. And it's a quote from a 60 Minutes episode with a rock climber named Alex Honnold. And Lara Logan asks him a question. It says, "Do you feel the adrenaline at all?" This guy would climb these sheer 1,000-foot cliffs, no ropes, no nothing. I mean, it's insane. If you haven't seen this on 60 Minutes, go see it. And Alex goes ahead and he says, "There is no adrenaline rush. If I get a rush, it means that something has gone horribly wrong. The whole thing should be pretty slow and controlled." Now, there's got to be a story as to why you opened your book with that. I love it. That's great. I mean, I want to steal it, but now I can't because you've already used it.
Well, I actually love that you picked that up. I spend a lot of time sometimes picking the right quotes for things, and usually people, and I had books I've written where I've had a quote for every chapter, and I spent a lot of time kind of getting the right quote. Nobody ever pays attention to it and so forth. And the reason I picked this one, and the reason I liked it so much, and of course I had no intention, I never even thought that when I was watching 60 Minutes and watching this story on this amazing solo climber, that it would lead to a quote that was relevant to the book. But when he said that, I said, that is really the epitome of trading. And it also flies in the face of what people think trading is all about. You mentioned trading to most people, and they say they have this picture of this adrenaline-filled room and people shouting orders, and it's all this tumult and emotion and aggressiveness and panic and all these things that people picture trading is about. And the irony of it is that the people who are really good at it, you walk into their rooms and it's like a library, and it's all carefully planned out. It's all controlled. There is no emotion. And that is really what a good trader is. I get one example, a trader I interviewed, and you mentioned I have some high profile names. I also try to pick out people who no one knows. And one trader I interviewed for this book is a prop trader who, ironically, the only reason I knew about him is my son got a job as a trading assistant, and he was working for him, and he told me about him. And the amazing thing how how he managed constantly. He was always winning, even when he was wrong in the market. I had this interview with him, and the day I came in, I remember this. So it was one of these days where it was after a period where the market had gone up for several months, almost every day. This was back, I guess it was early 2011. And the day I came in, that day, the market finally had a big break. And I knew that, for my son, I knew that he had been short, and I came in that day, and he was completely it was like a day where you would expect him to be really ebullient and enthusiastic, and really, bubbling over, sort of making back a lot of money. And you couldn't tell anything had happened that day. And I'm sure if I had walked in and it was the reverse and he'd lost a lot of money, it would have been the same thing. Just kind of even keel. And that's the thing about really good traders and really good rock climbers, and I'm sure really good a lot of things. It's not an emotional thing. It is really a careful, controlled thing. And if there's a lot of emotion to it, then something is wrong. And that's why I love that quote.
Do you think that aspect can be learned?
Well, if it's not learned, then you're going to lose money. So the market will teach it to you. You have to find a way, I think you have to find a way to trade where you minimize the emotion. And there are lots of ways to do it. And, a simple way is, and I've given this advice, through the people I've interviewed and quoting them on it, and also it's on my own belief, is one pretty good idea is, and Bruce Kovner of Caxton was the first one I think I interviewed in one of my books who said this, was before you put on a trade, decide where you want to get out. Decide where the trade is wrong before you get in. You do it then, you have complete objectivity, and you take away the emotion and all the turmoil of trying to decide what to do for position once you're in if it's not going right. So by doing that, if you say put on a position, you say, okay, I'm buying X at 75, and if I'm right, it shouldn't go to 73, and I'll put a stop in at 73, and that's the end of it. And you don't have to worry about it anymore. If you're wrong, you'll be wrong, and you know what you lost, and it's something you decided that's in line with what you can afford to lose, and it's in line with what the trade shouldn't do, and you remove the emotion. If, however, you just buy at 75 and it starts going down, and then it's at 74, and then it's at 73.50. Now you're deciding, what should I do? And it gets to 73. Well, maybe it'll bounce back, and you have to make all these decisions. Well, a simple way to get the emotion out is make the decision where to get out before you get in.
And what's really interesting about that statement is that, especially in this book, that applies over so many diverse trading styles. This is not this book is, when everyone gets this, you're going to see there's so many diverse trading styles in here. But one of the commonalities is clearly, and I even quote the one gentleman here from the first chapter, Colin O'Shea, and he says he wants to have a price point to invalidate his hypothesis before entry. And he's not a trend trader per se. He's more of an econ guy. But I think you're making that point. I see that commonality across this book, regardless of style.
Yeah, the styles are, in fact, extraordinarily different. In fact, they're almost more different than if you tried to make up different styles, you'd have trouble making up styles as different as the range of styles and the people I interviewed. So there's really no commonality, none, in what these people do to make money. But there is certain, as you point out, there is certain commonalities in terms of things like how they manage risk. Not all the same, but this idea of deciding what invalidates your trade is one that is shared by a number of traders. And Colin O'Shea states it as well as anybody. And he makes this one point that I particularly like, and he makes it in a way that I like the way he phrases it. He says that most people pick their stops by how much pain they can stand. And that's entirely wrong. What you need to do is pick your stops by where it invalidates your trade. not by how much pain you can stand. And if where it invalidates your trade is too painful, then that means you should be trading smaller. Not that you should pick a closer stop and have one that you can live with. If it's too much money to the meaningful point, then trade smaller. And if it's less than one contract, well, that's just not a contract. That's just not a trade you can do.
Yeah, I really enjoyed the chapter that Colin had, and he had some interesting discussions in there. And we've got a bunch of different places I want to target, but he had an interesting view how he was talking about the NASDAQ bubble period time, and it wasn't that he was necessarily trying to go short at 5,000, but rather 4,000. He was looking for that confirmation of things had changed, which I thought was really a nice direct way of saying it.
Yeah, well, the important point is, and he has some there are a lot of things in this book that are, I kind of think, different than people think. They're from traders who've been very successful, but what they're telling you is really not the way most people think it should be done. So mention bubbles to people, and what they think is, oh, wait, the way smart people make money in bubbles is to anticipate the bubble top and go short into the bubble and make money from all the fools. And interestingly, column on the subject of bubbles saying really the best way to make money in bubbles, well, there's two parts of it. The first part is you actually want to be long during a bubble because bubble moves tend to be relatively smooth. After the bubble bursts, it gets to be very, very jagged and very tough to stay with the trade on the downside. So actually the easiest place to make the money is along with the fools, so to speak. But of course, you're going to do it in a way that's tail protected. So that's the first thing that's sort of non-conventional about the way he looks at bubbles. And the other part of it is okay, you're expecting this thing, you look at this thing as a bubble. When it breaks, you're ready to now trade from the short side. And even though you're trading from a much worse price than you might have gotten in only a few weeks earlier, but it's the only way to do it, because if you try to do it while the market is in its vertical ascent, odds are that, or not the odds, but you have a very strong possibility of having to absorb an enormous amount of loss, probably more than you can stand, because when you get into that type of psychological phase, there's no telling how high the market goes. The NASDAQ happened to top a little above 5,000, but it could have been somewhere above 4,000, it could have been above 3,000, or it could have been above 7,000. When you get into those markets, there's no rationality. A stock goes from 1 to 100, a stock goes from $10 to $200 and then back to 10 or even down to 1. If it went to 200, it could have gone to 300. There's just no way of telling. So those are some of the points. And the other point that relates to this whole bubble idea is when you do get the bubble finally burst, and this is kind of a tangential related idea that he brings up that's important, the best way to take advantage is not necessarily the direct way. So the direct way would be, okay, short NASDAQ. Well, the problem with that is the NASDAQ move is going to be awfully choppy. In fact, during the summer of 2000, most people don't realize this or have forgotten this. You would think that if you went short the NASDAQ sort of in April and May 2000, you'd be sitting pretty and it would have been an easy move and you would have made lots of money. Well, the fact is that somewhere along the line, not that much further, somewhere in summer of 2000, there was a 40% plus rally in the NASDAQ. 40% plus. That's a hell of a retracement. And I don't know too many people who can stand that type of heat. So odds are, if you were short, you would have gotten knocked out. Now, what did O'Shea do? He actually didn't go short the NASDAQ. He said to himself, well, okay, this was a bubble. It's over. What does that mean? Well, it means the economy is probably going to weaken. What else does it mean? Well, it means that interest rates obviously have got to come down from where they are now. So what did he do? He went long bonds. And the beauty of that is that the bonds were a relatively smooth up move, totally correlated. The up and move in bonds were totally correlated with the down move in equities, but he found a much smoother way to do the trade. So that leads to one of the other lessons I cite in the book, is that how you implement a trade is actually more important than the trade idea itself.
I'm going to jump around some because I don't want anybody to accuse me of saying, well, Coveil, you picked the first chapter. You only read one chapter. That's not the case at all. So, but I have to tell you, I got the e-file, so everyone knows, I've got the e-file out there, and I actually got the hard copy yesterday. And, look, I know everybody's in love with ebooks and all that kind of stuff. But let me tell you, I'm holding this thing in my hand right now. It is, I don't know, 1.5 inches thick, 1.25 inches thick. It's sharp looking. This is, I don't know. For me, I want this on my shelf. I mean, I want this thing that has some weight that I can hit somebody over the head with. And this is a dense book. And I'm going to jump around a little bit on chapters here, because I think there's all kinds of interesting characters in this book, and I'm not going to even mention them all by name today. But I want to jump ahead to speaking about Ed Thorpe. And I remember back in the day, it was probably inspired by something originally said in one of your books about blackjack. And I went out and I bought the Beat the Dealer book, and I read that thing. And I was attempting back in the day to try and connect all that thought process. And here you are, you have this great interview with him where he's talking about all of his gambling experiences and his trading experiences. And as you point out, you're like, most people would probably not see the connection. Maybe you can speak to some of your looks a very interesting conversation with Thorpe.
Yeah, well, a couple of things. Well, first, let me answer directly your point here about connection between gambling or we should maybe say not gambling, but games of chance and trading. And in Thorpe's case, he did both. So there's a natural connection. But the best way to illustrate it may be to give a specific example. So take a game like blackjack. Blackjack, if you just bet a fixed amount every hand, you're going to basically lose money over time because the house has an edge. The edge in blackjack is less than it is in most games, and if you're gonna play a game in a casino, you might, the best odds is blackjack, but it still is a losing edge. However, what Thorpe realized mathematically was that if you varied the bet size dependent on how attractive the individual hand looked, that you could take a game that had a negative edge and turn it into a positive edge. And that's a really powerful thought. I mean, here is something, it's like you have a coin that you're flipping, and the coin doesn't even land on, it's not even 50-50 heads, it lands on tails 52% of the time. Yet he realized that because it's not purely random, that by betting more when the odds are better, you could take that 52% odds and turn it 52%, 53% in your favor, just by varying the bet size. And the analogy to trading is that one thing, and again, a lot of this is having some level of sophistication in what you're doing. So most traders maybe will bet the same thing all the time. The really good traders, when they have a trade they really have strong confidence in, or they think has great return to risk potential, they will bet more. As George Soros said, as I quoted Druckenmiller in one of my books, quoting Soros, is you have to know when to step on the accelerator. So part of it is betting more. And in blackjack, it's when there are different ways of doing it, but when there, say, when there are not many not many tens and picture cards out, you bet more, and vice versa. In a simplistic way, that's what that concept is. So you're taking a game which has negative edge and turning it positive edge by varying your bet size, and the same in trading. And in trading, it also means that when the odds are less, you either bet less, you take a smaller size, or you don't trade at all. I'll take a jump here over to another trader in the book who's actually more of an investor. He's the only person in the book that is more akin to a long-only investor because he just goes short occasionally always less than 10%. So he's much more like a long-only investor. And and this is Kevin Daly, and over a 12-year period where the S&P was like flat, he was up over 800%. And part of it, of course, is a stock picking, but a big part of it was just by being out of the market at the right times. And so when the odds were not good, he didn't he didn't trade. He didn't have, or he traded very small. He had very small positions. So this idea of varying the position size is a really important idea that can improve anybody's trading. So that's one example of a connection. And I can talk a lot. I kind of skipped Thorpe in his broader sense because I was trying to address your question. But if you want, I can go into something.
Well, here's the thing I want people to understand about this book. This is not a book. I mean, I read it over the weekend, but I could probably read it about 5 more times right now. This is not one of these books that you are going to just sit down and gingerly mosey your way through. You're going to have to sit down, read this, go back and look through it. It is dense and it covers a lot of material, cradle to grave, A to Z. And there's so many interesting little side notes and nuggets. And I thought one of the most interesting things about Ed Thorpe was that he found perhaps Bernard Madoff before anybody else.
Yeah, he had that was one of the, in fact, in Thorpe, there was like just an enormous, it was just like an astounding list of things that he was first at. I mean, in fact, of all the people I've interviewed, he is probably the single most amazing person in so many different ways. So, okay, so you're right. So let's pick Madoff. Yeah, he actually found Madoff probably, I'm trying to think how many years before.
His description of that was great, though. The way that he kind of figured it out was just it's worth the price of admission just to read that.
And he did it very carefully. He did it through analyzing the trades. And I mean, he realized, and it's in the book, and I won't go into detail in this podcast, but he put together that there was no other conclusion other than this had to be a fraud. Yeah. And he discovered that before many years before Marco Polo actually did. Nobody knows about it because he didn't make a big push about it. The investor who asked him about it, he basically told that, I would get out. This is a fraud.
It's one of those side stories that I could have you talking for a half hour, but it's one of those things worth reading. Like I said, I'm going to jump around, but I want to. There was a
before you jump on, just one other thing which I thought was amazing about what he was first at is that he found the Black-Scholes model formula.
It's true.
About 4 years before Black-Scholes, published their results. So he was really the first person to figure out the formula for pricing options. But in those 4 years, he was making tons of money trading it, and he just didn't want to publicize it to the world.
Well, you could probably say that maybe some of these traders that didn't get the publicity in the academic sense, perhaps maybe their achievements should have got them the Nobel Prize. Perhaps, maybe some of the academics got all the notoriety, but some of these great traders were actually implementing some of these great principles before the notoriety hit.
Yeah, that's something that I think very, very few people, I mean, I certainly wasn't aware of it. I doubt hardly anybody is aware of it, that he was really the first person to actually use the formula, and he did it many years before it was ever published. So that was another kind of amazing. And he also invented first person to do statistical arbitrage, first person to do convertible arbitrage. He is just an amazing person. Another thing, just from the academic side, this is another tidbit I kind of mentioned because I found it sort of so incredible. He was in a PhD for physics and got to his thesis writing stage and decided he didn't know enough math. So he went back and started taking graduate courses in math and then got a PhD in math. And he never went back to finish his thesis in physics, but besides that, he had done all the PhD work as well. But this is the kind of individual he was.
Everyone's listening here. Like I said, this is a very dense book. There's a lot of information here. But one of the comments that caught my eye in the book, considering you've really interviewed a phenomenal number of top traders, and there's a gentleman in here named Steve Clark, stat arb trader, I believe. And I think you make the comment in here where you said he's the most honest trader that you've spoken with. Was it just for this book or in general overall?
I think in all my books. And that was an amazing interview. I'll give you the context of this. And this is not in the book, so here's something that's not in the book at all that we can talk about. there was a trader that worked for Steve Clark. It's a group, Omni in London, and there's several hedge funds, and there's the general hedge fund that he oversees, and a couple of other strategies, separate ones. And there was a global macro guy who was very good, and I went to interview him. Now, that interview ended up not being in the book. The guy has a very good record, and he's a very good trader, but the interview just didn't work well. And without going into much detail, but in all my books, I have to do more interviews than I actually use, because I have to feel that the book the interview, once transformed into a written chapter, is going to work as a written chapter. And in this case, I didn't feel I could transform it. But he was the catalyst for my going there to begin with. And then I knew there was this other fund that the main fund also looked good, but it was an arbitrage fund. And it's very difficult to make arbitrage funds sound interesting. So I was even reluctant to ask for an interview. But I figured, hey, I'm going there anyway. I might as well interview Clark, who runs the arbitrage fund, and who's the head of the whole group. So I had the first interview first, and then I did Clark's interview, and I had such low expectations. I thought it was going to be boring. It was going to be very difficult to turn it into a thing. And he goes into his life story, a kid from sort of the lower middle class in a suburb of London, and no college education, and how he got into trading and ended up, becoming in arbitrage and all these other things. But his life story was really interesting, and he was very, very honest about all aspects of it, and very emotional at times, and very honest about what he liked and what he didn't like, and how he felt unfulfilled in his life. And it was just sort of almost a brutal gut level of honesty in that interview. And that's why I say, of all the people I interviewed, I thought he was the most genuine and honest of all. And he came up with a lot of extremely colorful anecdotes. And so personally, I really liked the interview a lot. I even considered making the first chapter. It was one of the ones I was considering as a possible first chapter.
Yeah, that line caught my eye because, like I said, you've talked to so many different guys, and that seemed like such an affirmative statement. I was like, wow, that must have really struck you, this interview, this gentleman.
Yeah, you could see the emotion when we were talking, and it's sort of like you watch an interview show sometimes, and the person gets a bit choked up or whatever, and they'll focus in on the face, and you could see the emotion. Well, I don't know if it comes if I got it across in the book, but it was that type of emotion that came across in the interview.
So I told you, this is what happens when you write a book with all these interesting people and different anecdotes and stuff. And so this is how my mind is circling around your material. But so there's another trader that you spoke about in here, and listen to the audience out there. We are lightly touching because these are dense, like I said, lightly touching on aspects of these chapters. You have a gentleman named Jaffrey Woodruff. I'm pronouncing that right, I think. Yes.
Yep.
And he's a CTA out of Charlottesville. And I thought the interesting thing about him, not a trend following trader, not a counter trend trader, but a pattern trader with a firm called QIM, self-taught programmer. I think the most interesting thing for me from that was definitely not a silver spoon guy, if I'm reading that correctly, but he was definitely influenced by Bill James, the sabermetrics guy. I mean, we're talking Moneyball here, seemed to be his philosophical foundation for a lot of what he does and how he ended up developing his trading firm. Am I beating up the right trade?
You got it exactly right. Yeah. If there is an idol that he would have in terms of expressing his philosophy, Bill James would certainly be it. And it's interesting how these things, which are unrelated to trading, actually have analogies directly to trading. You might not otherwise expect it. And in the case of Bill James and the whole topic of sabermetrics, it's the idea that by looking at different types of statistics and patterns, you could get a lot more information than you could by what was the typical popular RBIs or whatever. There were more interesting statistics that you could get, or that would give you patterns that were more meaningful. And it's very much along the lines of Moneyball, and well expressed by that. In case of Jaffrey, he essentially took that philosophy and tried to, and ended up doing finding patterns in the markets and building an approach that could find patterns. The big trick there was to do so without overly data mining and curve fitting. And some of the stuff, of course, gets to be proprietary, and there was some of the stuff he would only go to in detail just so far. But the essence of it is, and that's why I call the chapter The Third Way. As you said very correctly, he's neither a trend follower nor a counter-trend trader, but his process is really to find patterns in the market, and that is what he does.
Well, let me ask you, because I've got a couple more guys and some big picture principles I want to run over. But what? Let me ask you, as the guy that goes down this path, and there was a certain amount of time between this book and your last Market Wizards books. What were some of the things that you would want to be asked about that you? I mean, obviously it's in the book. There's a tremendous amount of material in the book and your own views too. But what's your big takeaway? How did this change you? How did this book change you? How did all these interviews change you?
That's a good question. I can give you, well, let's see what I can think. I can think of one comes to the top of my head. I'm sure there's more than one way.
Putting you on the spot, Jack. Putting you on the spot.
No, that's fine. That's great. Keep you from falling asleep. That's good.
Come on. I wouldn't let you fall asleep.
No, I'm teasing. You're actually asking very good questions. So it's an interesting interview for me too. And that's good. I'm enjoying it. So, that is an excellent question. So how did it affect me directly? I'll give you a good example. Jimmy Baladimas, the trader I talked about before, that my son apprenticed to. And, well, his style of trading, and we may as well go into it here, and he is probably talking about, first, of all the books I've ever written, he is the most different trader of anyone I've ever interviewed. And as I begin that chapter with a line that I think is very apropos, and it's also one of the better opening lines I have for any chapter I've ever written. It's a very short one, and it's simply Jimmy Baladimas breaks all the rules, and he does. And he sells into rallies. He doesn't use stops. He does things that are really reckless or seemingly reckless, but yet he makes money year in, year out. And I actually, not facetiously, even semi-facetiously, but also seriously, in the conclusion of that chapter, warn people that this chapter should be looked at like those late night infomercials where, don't try this stuff at home. So having said that, though, one of the things he does, and one of the ways he makes money, even when he's wrong, is he's constantly trading around positions. So he has, these months, when I went to interview him, the 3-4 months before I interviewed him, the market was up every month. He was short every month, and he made money every month. Or he broke even, but he didn't lose much. And the reason why that was true is because he's always trading around the position. So if he's short, the market goes down, he takes some. It goes down more, he takes some more. It goes back up, he resells it. So he's constantly making money trading around his positions. And I kind of believe in the idea of trading around positions anyway, but I think seeing the power of that, the way he's applied it, and understanding that even when you're wrong, if you do that part of it well, you could still end up ahead, was, I think, an important influence. And I think it influenced me to do more of that in my own trading, to be more inclined to take some off when it's going my way and put it back on. And one interesting thing about doing that is, if you think about it, it's going to help you. When is it going to help you? Well, it'll help you when the market goes into a correction. Well, you'll pick up some money that you wouldn't have. it may also help keep you in the trade, because if you're picking up money on the correction, you actually are happy when it's going against you, because then you can put the position back on. So instead of getting out of the whole thing, you're actually putting it back on. So it's very beneficial in those type of cases. Where is it going to hurt you? Well, it's going to hurt you if you take some off and it keeps on going. Well, what does that mean? That means that you've made money on the rest of it, so you make less of a windfall profit. And I like that trade-off. I like the idea that you're doing something in trading where it's going to help you when you would have been losing, and you're just going to give up some money when you would have been making more. I kind of like that trade-off. So I found that kind of an influence. It wasn't something that I had never done or anything like that. It wasn't a sudden insight. The insight was more understanding the power of it and getting a better appreciation for that as an approach. It is also, if you think about it, a way where you could be sort of not wrong necessarily on a trade, but let's say you go long or short and the market ends up chopping around, doesn't go anywhere. If you're doing this, you could actually end up making money on a trade where the market doesn't go anywhere from beginning to end, because you're selling some when it's going your way and then putting it back on when it comes back. So that's a good example of how there was an influence, but it's not certainly the only way. A lot of these traders had definitely have had an influence in things they said ringing true, and maybe reinforcing just things, even if I already knew them.
Jack, overall, the gentleman in this book, is it a fair assessment to say, I mean, self-starter entrepreneur types, really not silver spoon guys? I mean, a lot of these are self-made men.
I think so. If you think about all these people, and I'd have to go one by one, but almost all of them that I think of really came from, they didn't come from wealth. Like a few of them did come from upper class backgrounds, to be sure, but most of them really didn't, and some of them came from really, almost poor backgrounds. Thorpe grew up in the Depression, as an example. Clark, a poor working class family, that type of thing. So those are probably more representative of the backgrounds of these people. Very few really had any money when they started.
Well, let me. I know I mentioned early on that there are some very large names in here, and so just to whet the appetite of folks that are listening to this. So your second chapter is about a guy who, as far as I can tell, is the man when it comes to making gross money. I think you say he's made $50 billion for investors over 20 years, and we're talking about Ray Dalio at Bridgewater. So let me ask you, without going into and sitting here like I've done before on some of these other traders, what can you tell us about Dalio, your lessons, your insights, what you took away, some feeling that perhaps isn't really in the book, something that we're talking about the gentleman who has really just made an amount of wealth that's just it's hard to count. So what can you tell us that's not out there floating in the ether already about this gentleman?
Well, there's just a couple of things. For one thing, let me just say, in terms of his accomplishments, you have records out there like Joe DiMaggio's that maybe never get broken. And if I had to say, of all the traders I interviewed, what record will never get broken, well, Thorpe may be on his number of winning months, percentage of winning months, but Dalio has done one thing that I think is almost inconceivable that anybody could do again, and that is having a huge percentage year, and I forget what it was, like 30% or whatever. It was some very large winning, managing $50 billion. You would have asked me, a few years ago, before he ever did that, I would have thought it would be hard pressed to even make money managing that much money. It seems like such a huge disadvantage. But to be able to make a huge return managing a giant sum like $50 billion, that is like one of the most incredible feats that have ever been achieved.
And nearly systematic to add, right?
He's systematic here, but systematic different from
Absolutely.
what other people think of systematic?
Absolutely.
Systematic,
Save that for the read. They'll have to read about that.
Well, yeah. Well, we can tell them we can't say here that systematic without technicals, really.
Yeah.
So
it's very interesting.
Well, Dalio is very opinionated. He knows what he thinks is right and where he wants to go. And I think like a lot of great people have that quality, like Steve Jobs in a different field. Sort of the visionary people have that self-assurance and understanding. One of the important things about, there's a number of things that we won't go into all of them, but one thing I think that's important that Dalio brings out is that markets behave differently in different environments. So if you look at markets, and I'm speaking now fundamentally, not technically, but if you look at certain fundamental factors and try to find consistent ways in which they behave, according to Dalio, you're dead before you start, because that's not the way markets behave. Markets will behave very differently, say, if you're in a recession than if you're in a liquidating depression type of economy. Same fundamentals will work very differently, and you have to understand that. Otherwise, you're just going to be completely wrong, because you're trying to force one model across different markets, and the markets are just more complicated than that.
We've only got so much more time left here. I know I can't keep you all day, but hopefully we'll make the best podcast. So when people want to hear about this book, this is where they're going to go. So let me get you to be teacher for a second on a principle that is featured around one particular trader, and I'll let you name him. But I think it applies to a lot of these traders, and it's a kind of a very academic sounding statement, and perhaps you can break it down. But asymmetric positive skew trades. That's going to take some people a little bit of time to sit down and kind of wrap their arms around, but it's an extremely important point.
Yeah, it is, and I love that philosophy of trading, and it probably, I'm sure, comes through in the book. So what does that mean? Well, to put it in plain English, it means that you put on trades that have the potential to make a lot of money, but even if you're totally wrong, they can't lose very much. Now, the simplest example of this is a long option trade. Now, a lot of people will say, well, buying options is a mug's game. Options are overpriced, and you'll bleed money, and they'll do studies where if you always buying options, you'll end up losing. And all of that is true. And I'm using options only an example of how to set up a trade where you can make a lot more than you can lose. And I'm trying to also, in doing that, I also need to explain what's wrong with the way most people think about buying options. What most people really miss is that while on average, options have a somewhat of a negative edge, just like if you buy insurance on your home, the odds are, your house is not going to burn down, and the percentage, even across the whole population, home insurance buyers will lose money relative to the amount of money they collect in premium. And if that weren't true, insurance companies would go out of business. So that part of it is true. It has a negative edge. Okay, it's inevitable. Long options have to have a negative edge because you have to entice people to take the risks to sell you the option. Having said that, what the people miss is you don't have to be in the game all the time. The beauty of options is you can pick your spots. And if you can pick a spot where the market has a much better chance for having a large up move or a large down move at that spot, then options provide you actually a positive edge, but more importantly, they give you a way to trade that type of situation and have a very large potential on the upside while only risking a little bit on the downside, namely the price, the amount you pay on the option. So when some of the traders I've interviewed make a big deal about structuring their trades in ways where the upside is open-ended and the downside is very limited. Jamie May is one who's always does it, I think, on every single trade. Kyle O'Shea does it for most of his trades. And the simplest way I said is, as I said, is long options, but there's also being long CDS. There's other ways of doing those types of trades. But the simplest way and the way applicable to most people, or the way most people can do it, is by being a buyer of options, but at the right point in time. The great thing about it is that it's a way of controlling risk, but still giving you significant upside potential. And it's one of the ways where these great traders, it's one of the ways in which they are able to get very good return to risk performance.
Yeah, I think it's terribly important. I think the first gentleman you interviewed him in one of your original books was Larry Height, was always big on this concept. He had brought this up multiple times with me. So I saw that. I was like, oh, that's right on target. Let me, like I said, as we kind of wrap up, I can't keep you all day. I know people like to listen to you all day. I know I can always learn. But in the rear of this book, it's really cool. And I can't go into all of them. There's 40 of them, and you call them your 40 market wizard lessons. And I think it's obviously you're taking all these great insights and kind of reducing them to something that helps to kind of summarize what's going on in this new book. I want to give you the ability though here to expand on something, because I find this sometimes in my work. I'll get readers and they'll see something and they'll think they found some discrepancy in that I've written about. And I know I'm looking at number one, and number one is you're saying there's no holy grail in trading. I think hope most people can believe that's true. But number 26 is interesting, and I wanted to talk about this, the power of diversification. And you mentioned that Dalio says that is his holy grail to investing. So I don't know if you might want to kind of speak to, there's layers of how you're using that term.
Yeah, diversity. There are a lot of things that people kind of gloss over because, oh, well, yeah, diversification, I know it's important. But what I think people don't understand sometimes is how powerful some of these things can be. And one thing about diversification, and I use it in one of my other books, is it's the line, I think, something along the line of, it's the only free lunch on Wall Street. The thing about diversification, if you do it properly, it's a way of dramatically improving return to risk without really any negative to it, without any downside. And what Dalio's point is, if you have a strategy, and you pick your best strategy, and it has a certain return to risks, and that's good. But if you can find unrelated strategies, truly uncorrelated strategies, that you can increase your return to risk by as much as a factor, if they're really uncorrelated, by as much as a factor 5 to 1. So he sees there's a tremendous amount of potential improvement you can get in your return to risk, and it's all return to risk, not return, by diversifying. The way he does it is he finds ideas that have different drivers. So he's not paying attention so much to correlation, because correlations are misleading. They're backward looking, and you can have things that were uncorrelated can become correlated, or vice versa. What he prefers to do is to look at things that have different drivers. And if they have different things making the price move, then one should not be related to the other. And he puts together at least a minimum of 15. They have many, many more positions, but at the core, say 15 plus core positions that are completely unrelated. And that is one way he's able to get a significant return while still keeping his risk in control. And diversification is something that applies not only to as a trader, but it's also when you're investing. And sometimes that people talk about putting together a portfolio, say, of managers, and people will say, well, yeah, you put too many managers on, then you're diversifying the way you return. And I think that's kind of a very narrow-minded way of looking at it, because if you only pick managers that you feel are approximately equivalent in their potential. I mean, you can always pick the managers that are the best in the past, but going forward, you really don't know. So if even if someone did better in the past, you don't necessarily think he's going to do better in the future. So, or you shouldn't, because there's a very poor correlation there. So if you're picking managers who you think have equal probabilities of getting about the same return to risk, then you should have more. You should diversify, because if they all have similar expectations, you're not reducing your expected return, but you are reducing your expected risk. So again, it has a lot of applications.
One of the things I did not set up here in the beginning is your process for how you selected managers. And you went about saying, okay, I want to target guys superior return risk performance. And I'm going to let you expand on that and how you went about that process. As you think about it, though, one of the questions I would have for you would be your definition of risk as you lay that out.
Right. Oh boy, that's a good sub. Let's take that, and we'll come back to the process. The subject of risk, because this is one, and I mentioned that I have another book that I just finished writing, and in there I kind of have a whole chapter on this. But it's the whole confusion about what risk really is. Now, somewhere along the line, most of the investment community and a good part of the academic community, maybe most of the academic community for that part, has decided that risk is volatility. And the interesting thing, now sometimes it is, but the interesting thing about that is that you can have things that have very low volatility that are extremely risky. And in fact, their low volatility is one of the telltale signs of potential risk. It's not a sign of low risk. It could actually be a sign of potential large risk. And you can have things that look or are very volatile and yet have very low risk. And I guess we can kind of give an example of each. So, and this is where people go wrong all the time. They look at track records and they look I want a guy who doesn't lose much ever and has, makes a little bit of money, and that's great. And that's great as far as it goes, but you have to understand where are the profits coming from. So a lot of hedge fund strategies make their money by putting on the types of trades that win most of the time, but every now and then the train goes off the tracks and you'll get clobbered. But if within their track record, that particular strategy has not had one of those episodes, it looks great. Now, the simplest example I can give you is a strategy like selling out of the money options, okay? So if I were, in fact, if you wanted to be a charlatan in this business and kind of attract a lot of money, probably one of the best ways to do it would be you start a fund where all you do is sell out of the money options, way out of the money options. Now, what's going to happen is, in just about every month, you'll be making money because the markets rarely go to those out of the money strikes. So the markets go up or down a little bit, or even moderately is making money. The only time you get hurt is if the market really has a sudden, huge move. But the thing is, when it has a large move, you're not only losing money in that type of position, but you're losing money asymptotically, because those options you sold that moved 10 cents for every dollar the stock moved or the market moved now start moving 20 and then 30 and 40 and ultimately $1. So your position size is increasing at the same time you're losing money in that type of position. And what happens with these types of strategies is they get these strings of returns, which are very smooth, so low volatility. So the academics will look at it and say, oh, low risk. A lot of investors look at it and say low risk. But in reality, the process is one that has landmines planted sparsely. And it's fine as long as you don't step on one of those landmines. But ultimately, if you go far enough, you will eventually step on a landmine. And that's what happens. So that's an example of, and in 2008, of course, landmines were going off all over the place. And it was largely the worst hit strategies were the ones which had these low volatility, but high risk, what I would call low volatility / high risk strategies. So that's an example of low risk, of low volatility, not only not being low risk, but low volatility actually being associated with high risk. The reverse side of it is a trader like Jamie May, who structures all of his trades, as we talked about before, to be rightward skewed. And what he's always looking for is ways to put on trades where if he's right, he'll make a lot of money on the upside, and if he's wrong, he'll lose a little bit of premium. And there's a number of examples in the book about the types of trades he does, so I didn't go into that type of detail here, but it's basically the idea is that's how he structures the trades. And what does that do? That means that when he's right sometimes, he makes these huge profits, and when he's wrong, he won't lose that much. So you get a track record that has a lot of volatility. But the thing is, if you look at the track record, all the volatility, not some of it, all of it is coming from upside. And so you have a situation where you have high volatility, but his process is still relatively low risk because he can never lose very much on any individual trade the way he structures a trade. So it's a very, very important point, this breaking apart these concepts of volatility and risk. They're very different, and people go wrong all the time by linking them together.
Do you want to, I know we got a few more minutes here left, but do you want to touch on how you look at risk specifically, in terms of your measures? Sure.
I have one favorite measure, which I put in a book. I call it the gain to pain ratio. And it's actually, I kind of always assumed that it was kind of out there and people, but then I started searching for it. I Googled it and I found it was used generically, but I found that actually, even though it's a simple measure and in my mind, just about as good a measure of performance as you can get. If I only had one measure, this is what I would use. But oddly enough, it wasn't actually out there as a standard type of measure. The only place I found it in was in measurements of trading performance, where it's measuring trades, and there's something called the profit factor, and that is a statistic that's out there. And for your listeners who are familiar with profit factor, which is basically looking at the sum of all all your profitable gains to the sum of all your losing trades, that is the same analogous type of concept, but it's applied to a trade-by-trade basis. However, taking it and applying it to time data, like monthly returns or daily returns, actually, it wasn't out there. And it's well, I call it a gain to pain ratio. So what is the gain to pain ratio? It's simply this. You take, let's say if we're using monthly data, you take all the returns and just sum them. And then you take all the losing returns, only the losing returns, and you sum those and take the absolute value of it, the positive sign. And you take the ratio of all your trades to all your losing trades. And that's what I call a gain to pain ratio. And it's actually the one measure I use most heavily, and I can almost do without everything else. And I just give me the gain to pain ratio and monthly data and daily data, and I really can't extract very much more out of the pure data. So the reason why that's so good, and it's why it's better than, I think it's much better than the standard measures. It's much better than Sharpe ratio, let's say, because it will only penalize losses. It doesn't penalize people like Jamie May who have large gains.
It doesn't penalize upside volatility.
That's right. It doesn't penalize upside volatility. It's much better than ratios like the Kalmar or ratio or ratios which basically take your returns to your worst drawdown, which is something I'm not a statistician, but I have a little background in statistics. It's just something that's distasteful from a statistical standpoint, because it's you taking one event, the drawdown, and giving it all the weight, which is just not a good thing to do. The thing about the gain to pain ratio is it counts all the losses. So your maximum drawdown is going to be in there, but so are all the other drawdowns, and so are all the individual losing months. So it's basically weighting every loss you have ever taken. It's essentially taking all your gains and normalizing them by all the losses you suffered to get those gains. And I find that statistic is just extremely meaningful, and it's even more meaningful if you take it down to the daily level. So and I do have it in the book as an appendix because it is not a standard measure out there.
Listen, Jack, we've taken up your time. It's been great. I think people are going to really enjoy this. Maybe I've already asked this in a roundabout way, but is there any ones that just stands out in your head, memorable sentence, feeling, meeting, interaction in this entire process for this particular book that stands out for you? Is there one thing that you just walk away with and say, wow, obviously there's more than one thing, clearly we've talked about that, but is there that one that just kind of jumps out at you?
Yeah, we've talked about, I don't know if there's one, it's hard. It's always, that type of question is a little bit like the question I often
Which child do you like?
Yeah, that too. But let's keep it in the realm of market wizards. One question I get a lot of times is, who was your favorite trader, or who's the best trader? Yeah. And I really have a rough time with that type of question because there's so many different episodes, that it's and so many different people. It's kind of hard, to think of which one do you take. I
find the commonalities are what I remember. It starts to become that common type of can do, make it happen person. I'm not going to quit. I'm going to survive. I'm going to make it. I'm going to get to the top. I find that's how I end up remembering the people in this world often.
Yeah, and that is a characteristic of a lot of these traders. As is typical in most of my books, you will find a fair smattering of the traders I interviewed who didn't start off successfully, but yet they had that drive. Yeah.
Well, listen, you where were you calling today? Where are you at today?
I am in New York City, overlooking Central Park.
Ah, delightful. Well, I'm in San Diego today, looking downtown San Diego. So, well, listen, Jack, I will get this up hopefully this evening, and I'm sure everyone will enjoy it. I appreciate your time today.
And Mike, so you did a really good job. I really enjoyed this. You asked a lot of intelligent questions, which is the great thing about being interviewed by a trader instead of sometimes someone who knows nothing about trading, but just interviewing by book.
Well, I appreciate that. Let me ask you though, what's the best place for people to reach you? Obviously, you can go on Amazon, they can buy all the books, but is there a website where people can follow you along, or where can they find more?
Well, I do have a website right now, jackschwager.com, but pretty much right now it's more a venue for the books, and a couple of things are posted there. I haven't yet gone to the point of taking it over and really making it something, although at some point I will. For example, now we did this interview, I'm sure I'll put a link up to this and links to other things of that type. So one place is jackschwager.com. Perhaps not so much what's there now, but may be there over time in this process. And I did start Twitter for the first time. The book was kind of the catalyst. I started that a few weeks ago. And I guess that's a start.
Yeah, it's and then you'll be stuck for the rest of your life having to make tweets and Facebook posts, and it never stops.
Well,
the train never stops. So
I guess I'll find out.
Well, listen, Jack, once again, appreciate your time. I'm sure everyone will enjoy this. Have a good day up there in New York City today.
Hey, thanks a lot. Appreciate it.
Jumping into my second interview is Peter Brandt.
So today on the show, I have Peter Brandt, and Peter has been in the commodity trading space for a while. Good experience back to 1976, starting with Conti Commodity Services, a division of Continental Grain Company. He's been trading his own account for a long time. I think we're going to find out that Peter's got a lot of different experiences in the space and is going to be a great insight. His book that came out a few years ago, Diary of a Professional Commodity Trader, Lessons from 21 Weeks of Real Trading by Peter L. Brandt. The number one thing about this book, at least from my perspective, I don't know how a first-time author got such a great cover. So Peter, thanks for joining me today. Let's jump right in, Peter. Why don't you go ahead and give people out there, they hear, okay, you've been in the space, you've been trading your own account, going back to 1976, you were in Chicago for a long time. Where are you today, Peter? Where are you at today?
Well, physically, I'm in Colorado. Okay. Having moved from Chicago to northern Minnesota and then deciding that I wanted to live there in the mountains. So physically, that's where I am. Professionally, I'm trading my proprietary account as I have been, pretty much uninterrupted, although not totally, since the late 1970s, early 1980s, and that's what keeps me busy during the day is trading. And in addition to that, perhaps we'll have a little bit of a chance to talk about it. I'm jumping into the hedge fund world, although I'm doing so by finding people to allocate money to, not trading myself. But principally, I remain a proprietary commodity trader.
Gotcha. So why don't we go back in time a little bit? Because I think sometimes people want to live vicariously, walk in the shoes of someone's past experience and kind of how you got started. When did you first trade? How old were you? Where were you?
I was in Chicago. I had moved to Chicago after college to be in the advertising business, and I worked for a large advertising agency in Chicago, and met through neighborhood acquaintances a member of the Chicago Board of Trade, a local in the soybean pit, who invited me down to have lunch with him several times. I became captivated. I had always been an entrepreneurial kid, from paper routes to shoveling snow, all the way through college, tinkering with little miniature startups, and so I was entrepreneurial, and I saw the opportunity in commodities to go into a business where you can, you're your own boss, and you can measure your performance at the end of every day and not have to sit in conference rooms and meetings. And it was very appealing to me. So I made the decision in 1975 to leave the advertising business after really only being in it for a few years, and found a job at the Chicago Board of Trade, initially with Continental Grain Company, starting at the bottom like most people did back then, and still do to some extent in the futures business today, running paper, working phones, trying to find commodity users who might consider doing their business for Continental, and that's how I got my start. I took more than a 50% cut in pay. They had given me like a 6-month guarantee, and after that, it was up to me to try to find ways to make money for them and take a portion of that. And so I started at the very bottom and knew right away that I wanted to trade for my own account. I mean, from the get-go, I knew that's where I was headed, but I also knew that there was a lot about the business that I needed to know, and that if I didn't learn it, I probably would never really successfully trade for my own account.
So were you working for Continental Grain and trading your own account kind of at the same time for a while there?
Well, hey, I tried everything the first few years, Michael. I mean, I would make money at Continental Grain. I brought in a couple of very large accounts, and it was primarily through connections I had back in advertising business. I brought in, the largest one was the Campbell Soup Company, also McDonald's. And so they were doing substantial amount of cash business with Continental and hedging business. And so I had an income that actually accelerated pretty soon. And so it was for me trying to find a way to trade. And, at the Board of Trade, there were thousands of different ways that people were making money in the markets. I tried everything the first 4 or 5 years. I explored literally every conceivable way to trade for my own account: day trading, scalping, spreading, seasonal cycles, point and figures, you name it, fundamentals. And I patched together $4,000, $5,000, $6,000 and trade it, not real successfully, not miserably, but not successfully. And I went from approach to approach, really not settled at all on how I would trade. And then in 1979, another trader introduced me to the book by Edwards and McGee, Technical Analysis and Stock Trends. Actually, it was the earlier manuscript by Richard W. Schabacher that was written in the 1930s that laid out the case for classical charting. And I gobbled the book up in a weekend. I just consumed the book. And instinctively, I kind of thought, I've arrived. I know how I want to trade. Not exactly, of course. That evolves over time. It evolves through mistakes. And but it just made sense to me that I would be a classical chartist, and I have been since 1980.
Well, before I get into the trading with you, I think there's a personal story that I think people will really probably need to understand about you, and a story that revolves around your health fairly early into your trading career. And I was wondering if you might share that with the audience.
Yeah, sure. I left Continental in 1980 with a grub stake of $70,000 and started a proprietary trading firm, and cut my ties and dove in to the business. In a couple of years, we moved up to northern Minnesota, and then 4 years into that, in 1984, I had always been a sleepwalker, and I got up in the middle of the night, 2 o'clock in the morning, in August of 1984, made my way up to the roof of my home, which wasn't complicated because it was kind of a split level deal. It didn't require me getting on a ladder or anything, but it did require some climbing over a railing. And I took a Peter Pan off my deck, fell 17 feet onto a concrete slab at 2 a.m. while I was sleepwalking, and ended up in the hospital for 41 days. Had to learn how to walk, and that condition has stayed with me ever since. I have quite a bit of neurological damage that was done and has been done over the years through subsequent surgeries and arthritis and so forth. So it has kind of been the gift for me that has kept on giving, that little Peter Pan dive off my roof, and so that has been kind of a situation I've had to deal with here over the years.
Well, I tell you though, I had read in a prior interview even more of the details, and I think the audience will immediately grasp in your voice and how you're talking, and a passion, enthusiasm, and even for such a major trial, tribulation in your life, you seem, it comes across immediately very optimistic about, I know this is a long time ago, but still, as you say, it affects your life today. But I guess in hindsight, you've used the word blessing. Speak to that.
Well, Michael, I'm a firm believer that people who jump into trading learn from their mistakes. And I think trading in so many ways and so many examples, and I'm sure you could probably write a book on it yourself, trading is just a microcosm of life. There's so many commonalities between the business of trading and the business of living. There's so many similarities that occur, and I think one of those is just learning to live through adversity. Traders become good traders by learning to overcome adversity in their trading, by learning from their mistakes, by getting back up after being thrown from a horse. I don't know anybody who's come into the business and had a golden touch right away and has never gone through a period of adversity in trading. Trading has its ups and downs. Life has its ups and downs. To be a trader, you have to overcome those adversity periods, and such is life. So I think there's just a lot of commonalities between the two.
Let me jump right into following up on that. Let me jump right into a trading aspect here, and I've put 4 books out, and they've all been around trend following trading. And I thought what was unique about your work, a lot of similarities to kind of classical trend following, a non-chart pattern aspect of trading. But I wanted to read a quick section from your book, Diary of a Professional Commodity Trader. And it says, chart trading offered me a unique combination of benefits not available with other approaches I had attempted or considered, including, number 1, an indication of market direction. Number 2, a mechanism for timing. Number 3, a logical point of trade entry. Number 4, a means to determine risk. Number 5, a realistic target for taking profits. Number 6, the determination of a risk-reward relationship. And, and I know we kind of talked about this in email before we talked today about your passion for risk management. But when I look at how you're approaching your foundation of trading, and even though you are speaking of chart patterns and going back you mentioned back to the 1930s, some of the works that you studied, the similarities between the basic foundation of risk management, and trend following trading, as I've discussed, there's a real commonality there.
Oh, absolutely. I mean, I was at the Board of Trade when Richard Dennis started the turtle program, knew some of the early turtles, have followed some of the early turtles, have allocated money just recently, some of the remaining turtles, and yeah, a tremendous amount of similarity. And I think what it has to do with is cutting your losses short and letting your profits run, having a systematic approach to determining how you were going to trade, and developing around that a process of trading, trading as a business, being serious about it. And so I was a little bit acquainted with the turtles. I've also read some of your books, and so I think the similarities between other approaches to trading that are not necessarily based on classical charting and the approach I take, which is based on classical charting, have a lot of the same principles, and those principles really deal with stringent risk money management protocols, and that sometimes being even more important than how we determine what we're going to trade and when.
Well, and I noticed also in your work too, you come back to the final analysis of price.
Oh, yeah. I mean, for me, price is everything. And I know over the years I've tinkered with looking at indicators, and I'm not going to be critical of anybody who does indicators. If they can make indicators work for them, those folks who are listening to us right now, all the more power to them, whether it's MACD or RSI or stochastics or whatever the indicators are, even simple moving averages. There's a lot of ways to outsmart the markets by finding some little edge and exploiting it. But for me, indicators have just really not been something I've been interested in. Maybe that has been to my own detriment. I am sure that there have been some trades that I could have bypassed had I been using indicators. But my philosophy is that has been, why study a derivative of price when I can study price itself? And all an indicator is a derivative of price action. And I prefer to just look at price action itself through the charts.
You know what I want to do is I want to end up, when we end today, I want to kind of end where you're currently at today and the fund structure that you're working towards and a lot of what you're doing with that today. And before that, I want to kind of move into some of the broader trading principles that I know are featured in your book. But I think right now, since you've mentioned so many different early on, and I'm sure you still have perspectives of it today, the trial and error process that you have seen in trading and what works and what doesn't work. And I think it could be really useful having you on the show today to let you maybe give the audience some insights from your perspective about certain trading approaches. And I'll give you one example right off the bat. I'd just love to hear your view on it. I had somebody approach me recently and they said, well, there's absolutely no difference between this kind of longer term trend following time horizon, Michael, and trading 1 minute bars. And I just, there's a lot of different ways you could probably answer the question to the average trader that's sitting out there and he's got his computer and he's sitting down and he's saying to himself, I'm going to develop a trading strategy where I sit in my house and I trade 1 minute bars or 5 minute bars. Can you offer your perspective on those kinds of thoughts, Peter?
Yeah, I mean, I'm glad to, Michael. I just want to caution and give a disclaimer on that first. And it's my own experience, it's my own opinion, and I don't intend to apply that to universally to everybody else. I can respond from the standpoint of my own thinking, let me respond in a couple of different ways. First off, I think that it depends on whether one is doing a approach to trading which is systematic, that is completely systematized all the way down to order entry. It is a hands-off approach versus a trader who's trading a discretionary approach where there is subjective judgment that takes place during any process of the trading. I'm a discretionary trader. As a discretionary trader, my worst enemy is myself, my emotions. my fear, my greed, my second guessing, my doubts, and all of those things that go into that portion of who we are as individuals that traders need to overcome, particularly if they're discretionary traders, to be successful in the markets. I'm going somewhere with this, and so just hold on for a sec. But for me, that means that I need to remove, to the greatest possible degree, the emotional factor from my trading. I need to remain detached from the markets. And for me, what happens if I were to pay close attention as a discretionary trader to price action during the day, it would just be yanking my emotional chains in every which direction. And so as a trader, I have come to the conclusion over the years that what I need to do is put myself into a position where I'm making the fewest possible trading decisions as a way to squeeze out emotions. And in the process of doing that, to remove myself from market exposure during the daytime hours. I don't trade nighttime hours, although I periodically have orders in at night. But I trade the markets when the most volume comes into the markets and we have liquidity. Those are the hours that I use for actually entering orders. And so I've tried to reduce myself down to basically an order enterer. That's my job, is to enter orders that make sense. And to get rid of the emotions, I've just found that I need to take a bigger time frame. That, yes, I understand people say there's no difference between 1 minute charts, 5 minute charts, 60-minute charts, and so forth. But one aspect that I would say in an argument against that would be, that's fine if you absolutely have no emotions. But if you have emotions as a trader, and you find that those emotions force you to make decisions you know instinctively are the wrong decisions, a trader may need to examine his time frame. Let me just point out one other thing, and that is an experience that I have with charts. And we hear critics all the time saying, chart patterns don't work. The charts, you can't use the charts for trading. Chart patterns are unreliable. To that, I would say, you know what? I completely agree. The majority of chart patterns that form and are completed on charts actually do not work. What happens is a chart pattern forms, it morphs into a larger chart pattern, which often will fail, into a larger chart pattern, which will morph again and again and again, until finally we have a chart pattern which becomes mature. And that's a subjective deal, and I could spend an hour talking about chart pattern maturity. But I want to come back to the fact that if you take the fact that shorter term chart patterns have a higher failure rate than chart patterns that are comprised of many chart patterns that have failed, I would say that the 5-minute bar chart pattern is far more likely to fail than the weekly chart pattern. And again, that leads me back to my decision that I want to focus on longer term time frames.
And so when you say that the difference between, let's say, a 5-minute chart pattern and a weekly chart pattern, I mean, that's not just a personal opinion. That's objective analysis that you have observed over many decades.
Well, yeah, no, I wish I had data. I've accumulated data, and I'm kind of obsessed with keeping a lot of metrics in my trading. I keep track of a lot of numbers. I keep track of a lot of spreadsheets I use to kind of monitor my trading that give me kind of the pulse and the blood pressure of how I'm doing, besides just the simple profit and loss statements. And I would say most definitely for me, there are certain kind of chart patterns which I have found to be more reliable, much more reliable than other kind of chart patterns. And one of the aspects in looking at that would be the time length of the pattern itself. That longer time length patterns have had more reliability for me than shorter time length patterns.
And even I think for the audience to clarify too, that when you're speaking about the reliability of a chart pattern, it's if the chart pattern doesn't go your direction, risk management takes over.
Well, it has to, because the conclusion I've come to is that no matter what I might think about a market and how certain I am in my thought about the market, I frankly just don't have a clue. And the biggest danger I've seen among traders who come in as novice traders and try to become successful traders is they're biased, and they stick to a bias. They're not willing to change their opinion. From day to day, week to week, month to month, they get hung up on a narrative that they've created in their own mind, and they let that narrative make the choice for their trading activity, and they don't use money management. And so my conclusion is, on any trade, my default position is my next trade is going to be a loser. And I seriously mean that when I say that, Michael. I just assume when I put on a trade that when I take it off, it's going to have a minus sign in front of it.
Well, as you mentioned, novice traders, new traders, I believe you probably have almost a list of bullet points in your mind that might be, for example, if a novice trader was saying, well, geez, Peter, what are some of the biggest things I should be on the lookout for, biggest mistakes that I can make as a novice trader? Where should I be focusing my energy on things that I should be learning from, avoiding mistakes that I don't want to make? What advice would you give to folks?
Oh, wow. I mean, where do you begin with that one? And you've covered an awful lot of those in your own writing. But the biggest thing is you got to be properly capitalized. Traders can't come in, and I'm thinking of futures here. My world is commodity futures, is the world I live in, and I'm sure that the world stocks or ETFs is somewhat different. So I speak from the standpoint of futures and Forex, but you have to have the proper capitalization where every trade's not the beginning or the end of your life. The next point I would say is you've got to limit your risk. I mean, in my mind, I don't want to risk much more than 1.5. At the outside, several times a year, 2% of my assets and my trading capital per trading event. I can show and prove statistically that a trader who risks 5 or 10% of his trades and has a 50% win rate will blow out. It just statistical probability leads to that conclusion, and so it's risk. And then I think the third thing would be to be willing to make mistakes and know that learning to trade is a process, that it takes 3 to 5 years, in my opinion, for somebody to make enough mistakes that they can actually put together an approach to the market which has the chance to succeed. And so it's not expecting those early gains. And then I think another perhaps final point, and I could go on, but final point that I'll make is expectations. Novice traders, I refer to them sometimes as pedestrian traders, have expectations about trading which are basically unrealistic. And I think expectations which are unrealistic lead to mistakes. They lead to too much risk taking. They lead to having a whole set of bad assumptions about how to go about the speculative process.
I'll add to your idea of the percent risk. I was in front of an audience recently in the last 2 weeks. It was a good-sized crowd, almost a couple hundred folks, and I was giving a presentation, and I started talking about the number to risk on each trade, and I didn't mean to, but I picked on a poor fellow in the front row, and I asked him, I said, well, how much would you risk on each trade? And he kind of thought for a second. He said, well, 4%. And I said, well, what happens if you get 10 losers in a row? And it wasn't, for you and for myself, and I'm sure for a lot of other people that listen, it's an instant, you instantly crunch the numbers and you realize that's just not good. But I think for new traders, it really takes a second to kind of wrap your arms around the idea that you could have a string of losers, and 4% or 5% is the way to the poorhouse.
Oh, absolutely. And again, we've done a lot of probability modeling in our trading firm. We've looked at a lot of things which deal with statistical probability, random distribution, and so forth. And the odds of tapping out as one's risk goes up it goes up astronomically, and I don't know too many real successful traders who risk much more than 1.5%, 2% per trade. But I think most of them are down right around the 1% or 100 basis point level.
Let me jump into a book, and it's a book that I have to confess that I've not had a chance to absorb. I know it's a classic, the Edwards and McGee book, And I wonder, it's kind of hard on a podcast to be talking about specific chart patterns. I think people would need to get the book and see what you're talking about. But maybe you could sum up for the audience that have not had a chance to read that book, how it influenced you, how it inspired you, how you knew that that was the way that you wanted to go, how it really got in your soul, so to speak.
Well, again, and you mentioned some of those things. I'm a visual person. If someone's going to give me directions to go from point A to point B in the car, I don't want to see a written directional piece of paper which says, turn left on this street and right on this street. Just explain it to me. When you get to McDonald's, turn left, and then there's a large red church, and then turn right, and so I'm directional. And so the whole idea of a graphic representation of charts made sense to me. I loved math in school. I loved the subject of geometry in school. Classical charting is really an approach to the market which is based on geometry. And then as I got into it and really read the book, I realized that it gave me a lot of things that I really did not have and were looking for. And you had mentioned some of those, a way to at least take a guess on market direction, an idea of where I was wrong, an idea on how far a market could move, an idea on timing. And so it offered up for me a whole number of components that I felt were just intrinsically good. And so for me, it just was an approach to trading which fit my personality. Which, by the way, I think is extremely important. Is traders need to find an approach to the market which is kind of the quote unquote them. They need to find an approach that kind of reflects who they are, reflects their strong points, and adapts to their weak points. Because if a person doesn't know himself and his character traits, they just need to trade for a while. They'll find out real quickly who they are as a person. And I know for me, just an approach that was based on the geometry of classical charting just made sense to me.
Like I said, before we jump into where you're at today with your a multi-CTA pool, there's a couple other things I want to go over in terms of just basic trading foundations. And in our communications with each other before this podcast, you used a phrase that I thought was classic. You talked about, once again, I was mentioning novice traders, but novice traders having, and this is your words, I love it, an obscene dependence on trade identification. I just love that. An obscene dependence, not just a dependence, an obscene dependence.
Yeah, I mean, it's true. And that's why you see email advertising and web advertising that talks about a trading approach that's right 80% of the time, 70% of the time, 60% of the time, and so forth. And that's why you see an awful lot of new traders who look to find some approach to the market which gives them this huge win rate. And because they really believe that that's where the payout is. The payout is in being right 70% of the time. And what I think experienced traders would tell you is that is not where the payout is. The payout is in the value between the win value and the loss value. The payout is in managing your risk. The payout is in staying disciplined. The payout is in overcoming your human emotions. It's in all of these other things. And oftentimes, unfortunately, people who chase these high percentage rates end up losing all of their money before they actually figure out what the game was all about.
It's kind of jumping off from there too. If I think about one of the most classic Ponzi schemes in the last bunch of years, Bernard Madoff, and I've looked at the month by month performance that he put out that caused a lot of very wealthy and probably very bright people to make investments, and the whole scheme was predicated on just delivering 1% each month. No down months, just 1% each month. And that was enough to create a massive Ponzi scheme because this human mind of ours, this lizard brain, just wants to believe that the goal is this consistent positive performance and that it's obtainable.
Yeah, well, let me say two things about that, because that's a great point. Thanks for bringing that up, Michael. That's a wonderful point. Um, I have two comments to make. First, the investment community, the Wall Street investment community, people who place money with traders and with trading firms are obsessed with the Sharpe ratio. And the Sharpe ratio rewards people who make that 1%, 0.5% a month, 1.5% a month consistently. I don't believe in the Sharpe ratio. I think it's a fraud, quite frankly. I think it's very deceptive. It really doesn't tell a very good story, because the Sharpe ratio penalizes upside volatility, and it's upside volatility that I want as a trader. The second point I want to make is that I see a lot of people who, in the futures business, are sellers of naked options, and for years they go on and they do 1% a month, 0.8% a month, 1.2% a month. They do it month after month after month. And that is a strategy which is referred to as short gamma, when you are short options in certain positions. And my experience is that short gamma traders make money every month until they go broke. And so there's a price to eventually be paid, whether it's through statistical probability or it's through, in Madoff's case, of course, all of those numbers were fraudulent anyway. But yeah, there's a great appeal to investors to see kind of performance numbers which are, quite frankly, unrealistic.
Well, let's stick with here, and we'll even go into where you're currently at today. Maybe we'll circle back on some trading principles, since we've walked into this world of client expectations and your current incarnation, where you're at on this multi-strategy CTA. But when you talk about upside volatility, now there's a lot of people in the audience that are immediately going to get what that is, and especially for the trend following traders out there, because they know that Sharpe ratio is a terrible, terrible, terrible measure of professional trend following performance. But essentially, what you're saying is that by knowing that you can't have these consistent, and I'm going to let you phrase it how you'd like to as well, but knowing that this consistent 1% a month is not possible, and that you have to give your positions in the markets room to breathe. And room to breathe means that things don't just go up in a straight line, and that you could, maybe you reach a high water mark of 1,000. I'm just making up a price point, and it comes back to 900. Then it goes to 1,100. It comes back to 800. Goes up to 1,400. That kind of up and down is not necessarily a negative thing, and that's more what life really is, versus this fantasy of a straight line with never a down month.
Well, especially when you're trading leveraged markets like I am in futures. I mean, that's this kind of steady month by month performance as well if you have your money in annuities. But I don't trade annuities. I trade gold and soybean oil and crude oil and markets like that. And I put on trades that are losers, and so I have good months, I have bad months. And for me, the key is to kind of take a look at how much volatility I have. I don't know. I've had, I think last time I counted, I've had 15 drawdowns over 10%. During my career as a trader, I've had 3 over 30% and maybe another 2 or 3 over 20%. And so you have those kind of drawdowns. And those drawdowns, while they're never any fun, and while when you're in them you think that you'll never be out of them, the reality is that active traders have those periods of adversity, and you have to live through those periods of adversity and survive and stick to your guns and have faith in what you're doing is correct. But I'm very sensitive to drawdowns relative to profits, and it's one of the measures that I learned were drilled into me for a period of time back in the 80s when I traded for what was the original commodity hedge fund, Commodities Corp, and I was a Commodities Corp trader, and they just grilled into you different ratios which reflected upside potential against volatility, not using the Sharpe, but so they were always keenly aware of the fact that if you're going to average a certain percent rate of return over some X number of years, that you wanted your drawdowns to remain somewhere in a level below that. You don't want to average 20% annual rate of return and have 40% drawdowns along the way. And so there's that relationship between profit potential and asset volatility that I think traders need to be particularly aware of. And it's one of the metrics that I think all traders need to keep on their own.
Why don't I let you go into, like I said, we can circle back to some of the basic trading principles that have driven your career. But why don't I let you jump into where you are today, that and you've kind of mentioned that you see this as the next step and maybe the final chapter in your trading career, where you are kind of putting the prop trading behind and going to this multi-CTA fund structure. Why don't you talk about the idea of that and how you are going about that?
Yeah, sure. I will, Michael. As a trader and as somebody who has been fortunate enough to have profitable years over time, I've accumulated money in individual retirement accounts and IRAs. And as a trader, I happen to believe in managed futures. I happen to believe in good futures traders. But I could not take my own IRA money and trade it myself because it's a violation of law. You cannot trade your own IRA money in a leveraged, in a margined account. And yet I wanted my IRA money employed in the futures market. And so for me, it was a question of, if I'm going to give my own money to another trader, how do I determine that? Is there a means by which I can systematically look at other traders and measure their skill level? Because to me, rate of return is pretty much a meaningless number if it's not taken in relationship to volatility. I've had people come to me, I did 70% last year, 50% last year. Big deal. Often rate of return is a function of leverage and luck, and not necessarily of skill. And so I think that skill comes out when you look at a trader and you can develop some ratios between their performance and their downside volatility. And there's a number of ways to do that. There's the traditional way is CalMAR, which is California Managed Account Report ratio, which uses the worst drawdown. There's a ratio which I've always referred to as the anxiety ratio. Jack Schwager identifies it as the gain to pain ratio. It's measured in the same way. There's also a measure that I use, which is a ratio between downside volatility, or the second standard deviation of downside volatility, and average rate of return over time. And so I look at those, and I bought the database on about 1,400 commodity traders and spent a year feeding it through computer programs and developing computer programs to identify the kind of people that I would give my money to. And I'm in that process and have allocated some of my own assets to these traders. And I'm doing so by choosing traders that have an acceptable relationship between their upside performance and their downside drawdowns and volatilities. And for me, it's a matter of right now, I have 6 such traders, and it's a matter of picking traders and at least allocating to them in some ways that take a look at the negative correlation of their performance. You talk about trend following, which is an excellent way to go. But it didn't make sense to me to say I'm going to give the first amount of money, the first $1 million, to a trend follower, and then the next $1 million I'll give to a trend follower who basically is trading the same time frame. Rather, it made sense to me to find a trader who might do spreads, another trader who does trend following, another trader who is a mean reversion guy, another trader who is non-directional in their nature, all who individually have good numbers, good metrics, good results, trading approaches that when I understand them make sense. and they're people who I can get to know and have some level of trust in. And so that's kind of where I am, is really in the process of allocating money to other traders. And as I do that, I will probably wind down my own proprietary trading fairly significantly.
Now, does this process is there quite a bit of travel involved here? Do you get out and about on the road to go meet people, or how is that the daily grind of the new project work?
Yeah, you don't. I believe in relationships with people, and it's hard for me to trade because of my back and the neurological issues I have. It's very difficult for me to trade, but the degree I can, I'm not real interested in writing a check out to somebody for $5 million that I haven't met. And so I've done some travel, and I'm going to do some more, because it's good to get to know people and see what they do and meet their staffs and meet their compliance directors and try to understand how they go about doing business. And so there is some travel involved, unfortunately more than I really can handle, but nevertheless, it's the path I've chosen here for right now.
I didn't plan it with my particular journey, and I'm not putting a fund of funds together, but I've had the chance to travel quite a bit and go into the offices of many of these, frankly, top trend following traders, and sit down and really get to know people, and some people become friends. And I will have to say, for those that have been around for long periods of time and really stuck with it, I've found some just truly honorable people that I just like how maybe it's the entrepreneurial drive that wins me over. Just that they're just, they've been doing this for a long time. They're not part of the government. They're just, they're guys out there, women out there, and they're just making it happen. And I've just met a lot of honorable people in the future space.
Yeah, there's just some wonderful folks out there. But let me make one comment to add on to that, Michael, and that is that some people who get into trading think of wild and crazy adrenaline producing activities that a trader does. My experience in visiting traders and my experience in my own trading is, to an outsider, frankly, it ends up being very boring. I mean, what I do during the day in my own trading is a very boring process. And I like that. I like the quietness of that. I like for me to slow things down and to have things systematic and to do the same things at the same time of the day, every week, every month, over and over again. I've noticed that by getting into the offices of other traders, as you think there's shouting and yelling going on like we see on TV, the stereotype. And in reality, it's not that way. It's a very quiet process that takes place in the office of successful market speculators.
Yeah, there's no doubt about that. And I still remember when in the early to mid 90s, when I was first starting to get behind the scenes and see some of these environments, and it was very unique to me. You had obviously seen some of this many years before me, but it was at the time, and I still remember walking into Dunn Capital's office at the time, and they were managing over $1 billion in capital, a very long-term track record going back to the early 1970s, and there was not a screen on a desk. There was nothing to be. It was like walking into a CPA's office or to go in to meet with legal counsel. You would have never known. And I think until you see that as a young person and you truly understand that in your heart of hearts, you can get a little seduced by flipping on CNBC or Bloomberg, and there's all that screaming and yelling, and there's numbers flashing on the screen and all this excitement, and it's just not the way that it's done.
No, it's not. There was a wonderful story on ESPN recently about a pitcher, Kershaw, for the Los Angeles Dodgers, who Clayton Kershaw, who in his first couple of years had fairly average performance, but it was a wonderful piece where he came to a point in his pitching where he realized his mind was too loud. There were too many voices going on in his mind, and he went through an effort of, how do I slow that down? How do I think through this methodically? How do I live in the moment, so to speak? That's not the phrase he used, but that's how I took out of it, is how does he live in the moment, pitch to pitch? And of course, what happened is, is history. He went on to, become a Cy Young Award winner and is one of the best pitchers in baseball today. And he didn't change his wind up. He didn't change his kick. He didn't change his arm. He didn't change his grasp of the ball. The only thing he changed was his head game. And he did that by slowing his thought process down. I think there are a lot of similarities between things you hear like that from sports figures or business figures and the world of trading.
Well, my audience will be a little bit bored of me saying this, but I'm about 5 months into yoga. And, my yoga teacher, the phrase she uses is the mind chatter, eliminating the mind chatter. And I'm in the middle of halfway through this book called The Moment of Now by Eckhart Tolle. And it's exactly what you just said. It's, I think some people might kind of think, well, that's kind of frivolous, Mike, but a lot of these just basic texts that you can go pick up, these self-help texts, all about being in the moment of now and working on eliminating that chatter and that noise in your head, that the incessant thinking that doesn't do anything, is probably, once you have your system down, 95% of the battle.
Oh, no question about it. And the person who comes to mind on that right away is Ray Dalio, who's probably very well could be one of the best, certainly one of the best 5 traders alive today, perhaps the best trader alive today. And he was very much into that, slowing your mind process down early on in his career. And so that's not uncommon at all.
I'll tell you what, and we're going to wrap up here in a sec, but I want to let you go back, because there's a couple things on the basic trading principles. I want to let you run with these as kind of a wrap up. Averaging a loser.
Oh my goodness!
Run with it.
Look for another job. Yeah, quickest way.
But it's cheaper. It's cheaper now. I could buy more of it now. It's cheaper. It's dropped in price. Why not?
Yeah, I like buying stuff on momentum. I mean, that's the way I trade. I don't like buying things on weakness. I like buying things on strength. I like buying markets when they make 13-week new highs. I like markets when they clear previous resistance. I'm not a buyer of weakness. I'm not a seller of strength. I like to play the markets not from end zone to end zone, but in between the 20 or 30 yard lines. I think that's where the most stress-free profits come from.
And do I have to assume profit targets are out of the game too? I should not, as a new trader, I should not be thinking about my profit targets. They're going to just make the easy riches coming in every predictable time period. That's not good thinking.
Yeah, I mean, I'm a believer in profit targets. I take my trades off at predetermined levels, but you just can't rely on it. You can't have profit targets on, I'm going to make this much each day. I'm going to make this much each week. I'm going to make this much each month. That doesn't work. But certainly I know when I go into a trade, how much I plan to make on it if I'm right, and how much I plan to lose on it if I'm wrong, which is more often than being right.
Well, let me do this. As we wrap up, Peter, I want you to go ahead and give people not only where they can find you, and I mean, I've mentioned your book, I mentioned it again, which is called Diary of a Professional Commodity Trader by Peter L. Brandt, but give people a good overview from your perspective about where they can start. Maybe some other books beyond yours that you might recommend. I know we mentioned the Edwards and McGee book, but give people kind of and feel to take as much time as you'd like, or as least time as you like, but a good foundational starting point for where they might, a jumping off point for where they might go after listening to you today.
Yeah, well, I mean, people can find it on the web at peterlbrandt.com, but I don't blog much anymore. I've cut my blogging way back, and I probably will discontinue it entirely at some point. In terms of reading material, I think there's some basic reading material that people have to do if they're interested in speculation. A book that I recommend to folks regularly is The Devil Takes the Hindmost, which is a history of market speculation going all the way back to Chinese rice trading days and through European tulip bulbs and so forth. But it's just an interesting perspective on the history of market speculation. I enjoy the book. And then, of course, I identify the Jack Schwager books. I think every year between Christmas and New Year's, I have two traditions. I watch the Bourne trilogy, and I read all of Jack Schwager's books over again. I think there's so much wisdom to be had in what Jack has written about. I just love his books, and I think that they give people who are starting out trading a feel for the fact that there are many ways to, I don't want to say beat the game, because you really never really beat the game, but develop an edge. And they all focus on risk management. I mean, that's the thing they all focus on. They all have their own approach, and they all place risk management at the top of the pile in terms of being important. I have not gotten much into method books that I would call them, and so I really can't make too much of a comment on that, because I've kind of avoided them over the years, and but the books I mentioned, I think are must. The Livermore book, as well. So that would kind of be my reading list.
What'd you think of the Dalio piece, the long PDF that he has up, the long paper that he has?
Anything by Dalio is worth reading. And we're just fortunate that Dalio publishes online the PDFs of so many things. But Dalio's Principles, which is a 100-plus page principle about how he thinks about the markets, Dalio's piece on the quadrants of what drives the markets. There's a number of Dalio PDFs that are out there. Highly recommend reading them. They are must reads by anybody who is a trader.
Well, listen, Peter, I'm going to let you go, and I appreciate you spending the time today. And hopefully, maybe in the new year, we can connect back once your new project launches, and let us know how things are going. But I think people are going to really enjoy this. It's a different perspective, and I find there's so many interesting people in this space that, and they've all got a unique story and unique experiences. And like I said at the very early on in this conversation, the parallels between the strategy that you've chosen in your prop career and in my work, that parallel comes down to the risk management. For those paying attention, it's there. It's right there, staring you in the face. So,
yeah, it is. Well, hey, I have really enjoyed this, Michael. This has been thoroughly a thrill for me to do that. We've really never gotten to know each other very well, but I've followed you, and you have brought a good thinking to people through your books, and by covering the kind of the whole turtle world, which has been a major impact on so many people in trading. And so it's really been my pleasure to have spent this time with you.
Well, I appreciate it, Peter. And once again, guys, go out there, guys and gals, go out and grab Peter's book. It's worth the read, Diary of a Professional Commodity Trader by Peter L. Brandt. And Peter, we shall talk soon.
Third, and not the last interview on this massive, epic compilation episode, Larry Williams.
You're in Singapore? Where are you?
I'm in Saigon today.
In Saigon? Oh my gosh. One place I've never been. I always wanted to go there.
Where are you right now?
Virgin Islands. Virgin Islands.
You sound FM radio good, considering we're probably about 8,000 miles away.
It's amazing, isn't it?
It really is. It really is. Hey, listen, I want to jump right in, because as I was preparing for this interview, I do all my Larry Williams homework searches and all this kind of stuff. And the headlines that dominate in the last at least couple years are really about the title of your most recent book. I wonder if you might address that, because what's interesting about those headlines, these IRS headlines that you faced, is that it's really the beginning of the story, and the headlines don't reflect the end of the story.
Yeah, that's true, isn't it?
And I think the really interesting thing, and I'll let you expand on this too, is that, and I've not had a chance to read this book, and you can expand on it as much as you want. I think I'm going to go read it for sure. But the idea that when you had gone through this whole process, you ultimately said, and I'm paraphrasing, I can only put so much blame at the feet of the IRS. It's really about Congress. Is that a paraphrase, or is that close?
Since the book has come out, what we now know is the IRS has targeted specific peoples and groups. And I was indicted, and we'd been in touch with the IRS for years trying to work everything out. I was indicted the week that my daughter was up for an Academy Award, the Academy Awards week. And I was a great poster child within the industry, the fact that I was in Australia and she and Heath Ledger were a couple. And I had been in the United States before. Why was I indicted in Australia? I could never figure that out. But now, when retrospect and knowing that the IRS has been a rogue agency for a long time period, some pieces of the puzzle fit together better now. So do they target people? Sure. Was I high visibility with an industry? Yeah. Is it an industry they want to scare? Yes. So I was a great target. I was a poster child. So so whose responsibility? And ultimately, we should have a different tax system, and that's Congress's position. The IRS just enforces. But the way the IRS enforces things leaves one to question their reality.
You raise a great point, and I think everybody in the audience knows that there has been targeting, and I think it's a matter of public record. You raise a really good point.
Yeah, and clearly, in my case, I followed the advice of some lawyers and CPAs who were pushing the edge of the envelope, but they were Price Waterhouse guys and, lawyers, and they said, do this and you'll be okay, and I did that. And assuming for a moment the IRS was correct in their view, and I was wrong, there's no mens rea. I was doing what professionals told me to do to minimize my tax obligation. But the IRS would never listen to that viewpoint in negotiations prior to going to trial. Never, ever, ever. It was only, do you want 6 years in prison or do you want 3 years in prison? What type of deal do you want to cut? And I said, I'm not going to cut a deal. I'll go down swinging one way or the other. And eventually, of course, when all the charges were dropped, every single charge was dropped, they finally had a realization in trial that they couldn't win the case. And so on the third day of trial, they said we could see him texting back and forth to Washington, D.C. It was actually kind of funny. And then they wanted to recess, and they made an offer, and we talked and came back with it, and eventually said, okay, this is what we'll do. But their unwillingness to negotiate with me, well, they were with other people, I think just reinforces the targeting aspect.
Yeah. I mentioned to you in email, and I've not talked about this in my podcast, but I had a case in Virginia that went on for nearly 5 years. And in hindsight, it's very difficult when you really know you're doing the right thing, you really know the government is overreaching. And so I relate to the idea, and I'm sure many people, unless they've gone down this path to standing up to the government, you can't really truly imagine what it feels like to take a, quote, good fight forward, or to try and do the right thing, or to have not done anything wrong, and then to be on the other side of a behemoth that has unlimited spending power. Even at the local government level, they can hire whatever attorneys they want, and they pay whatever bills they want. It's amazing.
Yeah, somebody estimated they spent about $6 million on it. We spent maybe $2 million in my defense. And I've taken one case all the way to the Supreme Court of the United States, which we won. We took one all the way to the Supreme Court of Australia. We won at the High Court and lost on a split decision at their Supreme Court. People don't realize, I think, two things: enormous cost, and as you pointed out, the time. These things go on and on and on, and it just drags on your psyche. They just don't sense that, and the government will send out all sorts of news releases. We've indicted so-and-so, what a bad guy is. But after all charges were dropped, the government has yet to do a news announcement saying that we dropped all the charges. They refuse to do it.
Right there is the most telling example, and I'm not putting words in your mouth, but to me, it's the most telling example that it is personal. Because if it's the government and it's objective, if they want to announce the charges, then they should be willing to do the exact opposite when they're wrong. And when they don't, it tells you it's personal. And when the government's personal, that's scary to me.
Yeah, it is. We tried to not make it personal against the fellow who was prosecuting us, but either he had directions or he did take it personally. I don't know, but it's what you can get destroyed in the media, and then everyone forgets about it. And so that's the story. But when you're victorious, that story never comes out. And that's really the responsibility of good journalists.
Well, the book is called Confessions of a Radical Tax Protester. So for those folks that want to check it out, and for those folks that are tuning in and expecting us to jump right into trading, I frankly, like I said, doing my research here today, I wanted to make sure I kind of discussed this right out of the gate because it did make a lot of headlines. And I did notice that your daughter's name got tossed into it. And that's kind of, it's unsavory, right?
Yeah, but it's what is.
Yeah, it is. It is.
This is America. This is what they do. You have to learn that's how the game is played.
Yeah.
And you have to have a strategy to deal with that, an emotional strategy as well as a legal strategy.
Yeah, well, you seem pretty calm, cool, and collective about it. I might have had more of a meltdown.
Well, I think years of trading helped.
So listen, let me jump in, and I want to go back to your very beginnings because I announced to my Facebook that I was going to be speaking with you, and it is interesting. Your name, you have so many people that when they hear your name, they are just interested. They want to hear what you have to say, and they get excited. And I'm still a novice to some degree. I'm a newbie when it comes to Larry Williams, but I want to jump in and let you go back to the very beginning. And I've seen you give some comments about this before, but I want to let you discuss how you even decided to approach trading and what were your motivations?
Well, it began in 1962. I was looking at a newspaper and I saw that a stock was up 0.1 or plus 1. I had no idea what that meant. I come from a working class family. We never owned stocks. And so I said to a friend of mine, what does that mean? And he said, well, if you would have bought that stock yesterday and got out today, it would have made $100. And back in 1962, that's probably like $3,000 today. And I go, wow, this is for me. You can just guess and something goes up and make money. That's really attracted me. So it was just pure. I'd seen my dad work real hard in an oil refinery all his life. And he always said, learn to work with your head, not your back, like in his hands, like he has. And I thought, wow, this is interesting. You just make money looking at a newspaper. And of course, I thought it would be easy. And of course, I've come to find that that's not correct at all. But that was just pure greed, what first interested me in it.
Let me take even a step back further. You grew up in Montana, right?
That's correct.
So I've not had a chance to visit Montana, but and I think people hear Big Sky and they know it's a massive state. How did growing up in a state like Montana, which is a state of resourcefulness, a state where you probably have to take care of yourself a tad bit more than growing up in a big city. There's a lot more that you have to be aware of and take care of. It's the life in being I don't want to say the country, but just a more rural growing up. How did growing up in Montana affect you personally?
Well, I think first of all, that's probably the most insightful question I've been asked in any interview. I've never been asked that before, but I have cogitated on a bit. And I think two things. First of all, as I see kids growing up in a big city, it's hard to be really creative because your mind doesn't just flow in the mountains and the streams and hiking. And I think you can get much more creative growing up because you learn to create stuff in the environment and see it change. So I think that's been very helpful to me. And the other thing is that everybody in Montana is hardworking people, or at least it was back then. And you really treasure money and hard work and a work ethic that says, I used to ride rodeo, and you're going to get bucked off, and it's going to hurt, but still you get on, and hopefully you can hang on, and you're going to win. It's kind of like in the markets, really. You're going to get bucked off, but if you stay on, you win some money. And you pay to ride rodeo, and you get bucked off, you don't get anything. And it's kind of like the market as well. So I think there was that general idea of entrepreneurship, though my father worked for a large oil refinery all his life. My grandfather had a grocery store, and maybe I got the entrepreneurship from him. But just the idea in Montana, it not only is a big sky country or the treasure state, but it's big thinking country. You just it's amazing the people that have come from Montana, the things they've done, in part because I think they have that very open mind about, hey, I can do whatever I want to do.
Well, and you've done that. I mean, back in the 1970s, I believe you were the Republican nominee for Senate on was it 2 elections?
2 elections. I lost to Senator Baucus, who went on to be head of the Finance Committee, and Senator Melcher. And unfortunately, I chose to run against incumbents, which is really a tough position, but occasionally they get knocked off. It was a great opportunity to.
I know I'm bouncing around here a little bit, but you've got such a varied background, so you have to excuse me. Look, here we start the podcast talking about this most recent issue that you had this battle going on, but politics is the ultimate battle in the government. So here you are running. How did you decide to put your name in the hat ultimately? I mean, what were you thinking to yourself and say, I'm going to run for Senate? What was going on in your head? What did you want to get across to the people? What did you think you could do better than the guys that were out there?
Well, in terms of the Republican primary, I actually called the chosen guy who was running for the Senate, and I said, "Hey, Bill, I'd like to know where you are in your positions on a couple of issues. Maybe I could help you." He said, "Well, I have a committee that will tell me my positions on the issues," and that just turned my stomach. I thought, "What? You don't know your own positions?" That kind of was a triggering agent. And then, to be really honest, one night my buddy and I were driving Montana back from someplace, and we stopped and had a couple of beers. And about 5 beers later, he figured out that I should run for the U.S. Senate, and I was too dumb to disagree with him. It was really all about less government. It's the same issues today. Nothing's changed. We should probably have balanced budgets. We should probably have less government. We talk about that we may run out of money for Social Security, but we never talk about running out of money for welfare checks. But like this whole system's out of balance. I had seen too much government interactions with the SEC and CFTC and in my business. So I figured, hey, you know what? Montana's got some problems. I understand futures, future price, wheat, cattle, oats. So I felt that I could represent the average voter better than the other guy. And that's what got me in the office running.
So a quick story about me. When I was 21 years of age, I was living about 15 miles outside Washington, D.C. in a small town in Virginia. Today, one of the wealthiest counties in the country based on the numbers of federal employees living there. But when I was 21, I actually ran for mayor of the community I live in against a guy who was 72. And I have to tell you, putting myself in the spotlight at such a young age to be involved in politics, and it was a serious type thing, that changes you. You either continue with it or you say, you know what, I've had enough. I'm going to go do something else with my life. And I said I had enough.
Yeah, I can certainly relate with that. I think there's a point where if you're heavily involved in the political process, I was regional director for John Connolly's presidential campaign, worked on Ronald Reagan's campaign and Jack Kemp's. I mean, you did a lot of Iowa primaries and stuff. And after a while, you kind of say, you know what, enough. It's like in boxing, protect yourself at all times. I got to protect myself, get out of the ring here, make certain these guys, don't continue to screw up my life. And that's one reason why I'm in the Virgin Islands. It's great tax structure here, a lot of freedom here. We're part of America, but yet it's different than America.
Yeah. Well, let's jump back into trading. This is what most people want to hear. They want to hear your insights. And I want to go back to some of the beginnings and maybe let you elaborate on a word that I love. And it's often a word that is, how do I say this nicely, bastardized in common parlance, but the word speculate. To speculate is an awesome endeavor, in my humble opinion. How do you feel about it?
Well, yeah, and if we go back to the Latin root for the word is specular, which is to see, like glasses, spectacles, right? And the difference between a speculator and a gambler is we observe things and make certain references and then determine what the future should be. So we're not gamblers. We're actually making observations, and based on those observations, we're correct or we're not correct. And it's interesting. The other day, somebody saying, "Oh, you speculators drive up energy prices," and they're all upset about speculators. Okay, I don't think they do. But if they do, what about when energy prices collapsed a couple of years ago? Do speculators get credit for that?
Hey, don't ask the obvious question. Don't ask the obvious question.
Yeah, they only look at it one way, and they don't really realize that if we didn't have speculators, the markets would be much wilder than they are.
Yeah. So why don't you continue on this thinking? So you're in Montana, you're a young man, you're wrapping your idea around trading, you're seeing starting in stocks. How did you make the migration to thinking about commodity futures? I mean, I naturally, I think, and I've talked to Salem Abraham, who's a trader out of Texas, about this, growing up around cattle and whatnot. I think it's a little bit different than kids that might grow up in the city. You actually see and understand some of the mechanisms for the buying and selling of animals at a young age.
When I understood math, a broker told me that I could get, without having to pay interest on a margin account, I could control $30,000 of pork bellies for $500, or I could buy $500 of stock. Where do I get my biggest bang for my buck? And once I had that realization, I thought, well, futures is a lot more attractive in terms of what your potential is on the upside, and of course, on the downside as well. But that was the really switch point, was just the economics of it, that I got a much better deal, and that there's real demand and supply for corn and wheat and gold, and there is no real supply or demand for IBM or Apple or Google. I mean, you really don't need a share of Google. You can live the rest of your life without it. But you can't live the rest of your life without wheat and sugar and coffee and corn and gold and silver and all these things. So we have real data about those markets, real fundamental data that we don't have in the stock market. There's no true demand for them.
How did you start to put the pieces together, though? Because for the average trader, for the new trader, even for the established trader that's out there, there's a lot of different factors going on. So you have the emotions of it all. People just getting excited. They flip on CNBC and there's 6 suits jumping up and down, and you start jumping up and down, and you call your broker. But then there's the issue that you brought up with the leverage inherent in commodity futures. If you don't have risk management, if you don't have a money management strategy, you can end up in a bad place fairly quickly. So how did you start to put the pieces together about the emotional part of it, the money management part of it? I'll let you continue there.
Well, I guess I was lucky. There was no CNBC when I started. So you didn't have all those things pulling at you. I really just got into the first book I read was Joe Granville's book. And later on, Joe, who unfortunately passed away a month ago, became a friend of mine, both he and Karen. His book was very inspirational about, there was logic to this business called stock trading, but it was all technical. And I traded as a technical-only guy for probably almost the first 10 years. And then I met a guy, Bill Meehan, who had been a member of the Board of Trade, who was really into the fundamental aspect and taught me the fundamental aspects of markets. And we came together, 2 guys, Keith and Kevin Campbell, who run one of the largest funds now in the world out of Baltimore, had been a friend of Bill. And it's really interesting. Bill was the inspiration for a lot of guys. And what I got from Bill was that markets get set up for big trend moves. Technical stuff will call all the trends, but you get whipsawed to death. So what you want to do is put a trend mechanism on top of a fundamental conditional setup market. Then trend isn't just hoping that one of these things goes up. As a speculator, you're observing that this time, this trend change should be better than just a 20-day average crossing a 10-day average or whatever. So that was the total perspective Bill gave me, the conditions set up markets for trend moves. And his problem, why he came to me, why we worked together, he had no clue about technical stuff, timing. Technicals are all about timing, but you don't know if it's going to be a massive move. You don't know the magnitude of the move. Just because you get above a 50-day high, it doesn't mean you won't go right back down. But if the fundamental conditions are there, then the trend change is much more sustainable.
I have to admit fully, and I think you probably know this about me, I am not a fundamental guy, and I can't add any value there. I can appreciate that there are definitely people on this planet, and I think you've had some experience there for sure, who have been able to pull it together. I know Ray Dalio, and I sometimes want to know what his secret sauce is, but Ray Dalio swears, I don't know if he swears, but he says that he trades only using fundamentals, but trades them systematically, which was intriguing to me.
Well, when we were roommates together many years ago in New York City, I think he scoffed a little bit at my technical stuff, and I scoffed a little bit at his fundamental. It wasn't until years later, that I haven't even seen Ray since somewhere in the 70s, that it was really interesting. We both pop up again with a little different trading style, but clearly I think fundamentals are the basis for the magnitude of moves. And I know students of mine who now manage money have taken my work. This is exactly what they've done, what we've always talked about. They'll take a turtle channel breakout, but only if there's a conditional entry there. And of course, then you don't have to wait for, say, a 20-day high or a 50-day high, because if the conditions are there and they're ripe for a significant move to the upside. Then you can buy at a shorter time period, high or moving average or whatever your technique is, because the stage is set for a big up or a big down move based on the fundamental conditions of the marketplace. I don't disagree with trend following. I think it just has to be used selective. I don't disagree with using a hammer, except you got to find the right place to use a hammer.
Yeah, there are different approaches. I think sometimes what I do, and people get into debates with me, I've enjoyed being in the trend following world because there was so much data to observe. As a young man coming into it, I could see all this data and observe it. On the flip side, if I picked up Seth Klarman's Margin of Safety as a young man with a political science background in my early 20s, that was a much more difficult proposition for me to wrap my arms around.
Well, margin of safety, I think that's one of the incredible learning experiences that I went through, and that maybe every trader eventually has to face, and that is the risk control aspect of this. It doesn't matter if you've got the greatest system in the world. If you don't learn how to control and bet size and manage your account, you really have to manage the markets, your trades, you have to manage your equity, and you have to manage your emotions. You've got to really touch on those three legs if you're going to be a successful trader.
Well, I brought those up a second ago. So why don't I let you expand on the phrase money management? Because even though people have heard it, it's not something that resonates with a large segment of the population. Many people, you could take a doctor, an attorney, a young man out of college. It's a subject that's still, you've been at this for a long time. It's a subject that's still in the weeds. It's still hidden away. The idea of money management, bet sizing, position sizing, however one wants to call it.
Well, I'll make it real exciting here. I took the $10,000 to $1.1 million in a real-time trading championship because of money management. My daughter, when she was 16, took $10,000 to $110,000 real dollars in a trading championship. And a lot of my students have done this similar thing or comparable. Nobody's got our records yet, but they're trying, and they do really well. And it is, sure, they're decent traders, maybe even good traders, great traders, but it's the money management that gets the exponential growth of the account. But that sort of has two sides to it. And really, to simplify it, it's that trend is the basis of all profits. No trend, you're not going to make a nickel. But trend is a function of time. So the time you're in the trade, it gives you more opportunity for trend, which is why day traders have the deck stacked against them. Time runs out at the end of every day. They cannot catch a big move. So they have to bet large to make a lot of money. My game is to bet small, and if I lose, then I can only lose small. Whereas if I catch a trend move, I can catch a substantial profit because I have time in my favor. So your time frame is part of your risk management. And the overall underwriting rule is really bet small to win big. You have to bet a correct amount based on your system. But even at that, as I mentioned earlier, if your emotions don't allow you to handle a $50,000 loss and you're trading $1 million account, whatever, if your emotions don't let you handle that, you can't make that size of a bet. It isn't just the math of it. You've got to actually have an emotional quotient on what risk you can emotionally handle, and then strive to find where that optimal F is that Ralph Vince has written about.
Yeah, Ralph was on the show. Ralph is a really interesting guy. I'd love to meet him in person. He was awesome.
He's the smartest guy I've ever met. I've met a lot of brilliant people. I don't know if you're aware of, you've probably read Ralph's books. Ralph never took a class in math.
Yeah, it's amazing.
That's all self-learned. He's amazing and just a great guy. Just had a lot of good times together.
Let me keep going on the money management though, because I think let's phrase it this way. I've done this before at an event, you tell people, you say, listen, okay, you got $100,000. How much are you going to bet on each trade? And I've asked a room of 100 people this before. And it's amazing, the numbers. You've got people that raise their hand and say, I'm going to bet $10,000 on each trade. They only got $100,000. They're going to bet $10,000 on each trade.
Well, if your emotion can handle it, and I would precede it with that, the maximum bet that I would make would be a 4% risk or $4,000 potential risk in the trade. I think that is the optimal number, all things considered, for most all traders. Probably a 2% is more manageable. And people think, well, I can never make much money with a 2% risk. couple of years ago when in Australia, I started a $100,000 account. A year later, it's a little over $1 million. And it was on 2% risk bets. Probably most were 1% risk bets. So you don't have to bet big to win big if you're catching large moves in the marketplace. I think optimally, and I can show mathematically why 4% is about as heavy of a bet as you want to make. Or as a risk, not a bet, but a risk. That's how much, if I'm wrong, I'm going to lose 4% of my account.
And you would consider 4% on the heavy side.
Pardon?
You would consider 4% to the heaviest end that you would go.
Yeah, to the heavy side. And here's why. It's not uncommon for me to have 3 or 4 losing trades in a row. So if I have 4 losing trades in a row at 4%, I'm down about 16-20% of my money with slippage and whatever. And so that's frequently happens in everybody's systems or everybody's trading approaches. So I have to be willing to have an equity drawdown I can live through, not sit through, but actually live emotionally through that. And a 4% risk that's pretty gutsy.
Why don't you talk about the emotions? Because you just said that, living emotionally through it. Somebody's listening and maybe they think they know what you're saying, but do they really know what you're saying? Is it it's the waking up in the morning? Is it you're thinking about it too much? And I'm not saying you, I'm just saying the wrong way to do it. That you're thinking about it during the day. Talk about that, the emotions of it all.
Well, I have a lot of experience in doing the wrong things in the markets, so I'm real qualified to speak on this one. The other things I don't know, but I've done a lot of wrong things in the markets. And I think the underlying thing is the human brain is wired to be right at all costs. So we get into arguments because we want to prove we're right. People kill people on freeways because somebody cut in front of them. We'll be dead right, literally. We just have to be right. And in the markets, you can't be all right all the times. And you have to learn to accept that. And if you can't accept that, you get really frustrated and very angry about the markets and that you're losing, you're not making money. The guy next door, your brother-in-law, is making more money. And it's just, it isn't just the size of the loss. It's the fact that you're losing, and maybe 2, 3, 4 times in a row you lose. And that makes you think you're a loser. And you get in all sorts of emotional traps. I don't know if you're aware, my son's a psychiatrist trained at Johns Hopkins and did an interview with 20 major traders, big-time traders, names you know. And the takeaway from his in-depth personality profiles of all these people is, he's the first person to just interview successful traders. None of these successful traders have really big egos. They're not overly confident people. And that was one of the most important takeaways to me, is that we have this impression that traders are gunslingers and they're totally confident, and those are the losing traders. The winning traders don't have a great deal of inner confidence, and that's why they control risk so much better than guys who think that the God's gift to the markets.
I feel very fortunate to have sat down, talked with, become friends with, shared experiences with some men that have so much market success that their kids, maybe 500 years from now will still be living off the residual. And you're right. Most every one of those people that I've had a chance to be around, names that people would know, they put their pants on exactly the same way. And they just act down to earth. They've had a system, they've had an approach. Maybe there's been a little luck on their side, but they've grinded it out, and they've been at the right place at the right time, and things have taken off. But I find they're just down to earth, very down to earth.
Yeah, you look at a guy like Steve Cohen, who's just, you wouldn't have any idea this is a billionaire, 4 or 5 billionaire type guy, done 30% a year for 30 years in the marketplace, and he doesn't have that persona that the movies have made out, or somebody like Paul Tudor Jones, Ray Dalio. And these guys are pretty much salt of the earth people. And understanding that, I think, helps us to become better traders, to see what the personality profile of winning traders is. Another interesting thing that Jason's book pointed out, his research showed, is that all of these really successful traders found a strategy that fit them. So some are fundamental, some are technical, some don't want a system. Some, if you gave a system to, they could never follow it. But they're really good traders on their own, using their own discretionary ideas in the marketplace. And they had to come to that notion. Some went from going to systems to discretionary. Some went from discretionary, realizing that they had to be a system trader. Your personality dictates largely the approach that you should be using in the marketplace. And too often people say, oh, Larry Williams, I'll just follow his stuff, or I'll just get the turtle trading system or whatever, not realizing, does that fit you? You really have to answer that question.
And that's a good question too. What is the definition of fit? And I think that not as much research as your son, perhaps, but some of my casual observations is that most of these men they said, well, what is this a good opportunity? What's the science behind it? Let's stick with it. Let's execute it. Let's run it like a business. Let's have a profit center. Let's run it like a business. And I think that seems to be a common thread that I've seen in so many of the traders that I've had a chance to sit down with, learn, and interview from.
Well, and I think the ones that you've interviewed, which are legendary traders, they are different than guys like me. They are so much smarter because they're not only great traders, but they put together business enterprises. I'm basically a writer. I have my degree in journalism that turned trader. And these guys are business guys that have put together organizations of thousands of employees underneath them, managing billions of dollars. So not only are they great traders, they are brilliant, absolutely brilliant business people. And there's a real difference between just the trader and somebody who can make a business out of the art of trading. I mean, I have so much respect for these people. They are just so far ahead of most of us in terms of just the intellectual qualities of their life. Oh, my gosh. Amazing.
Taking on the responsibility of losing money for other people is not easy.
Not fun.
No, that's not fun at all. Hey, listen, let me shift gears on you a little bit more too. So the idea of markets changing or the conditions in markets changing, I think many times people, maybe new traders, they approach the markets and they get caught up on this word change. So let me ask you, big picture wise, how much has really changed about the condition of markets since you got started to today?
A lot has changed, but it's technical change. It's change in how long it takes news to get disseminated. I'd get the Wall Street Journal 3 days late. The content and the delivery time period of news took much longer. Now it's instantaneous. So that's one thing to deal with. But the big change really is, we've gone to electronic markets. I made fortunes off the opening gap from the day close to the next day's open. And because we had a time period of, 10 hours, 12 hours where nothing was happening, well, we don't have that gap anymore. So I had to seriously alter a lot of my trading styles because I didn't have that opportunity to take advantage of anymore. So that's a huge, huge change in terms of my trading. But I still think supply and demand drives the markets, and the technical emotions are really technical, I think, measures emotions. The wiggles and waves as we go from point A to point B are technical. The overall trend from A to B is fundamental. And those emotions are still the same. As you know, we can go in any country in the world and look at their markets, and they just look like the markets here, except maybe China because you can't sell short. But the same patterns are there that we see in our market. So these aren't chart patterns. These are patterns of emotion. And we're all humans. We all have fear, greed. Doesn't matter what your culture is. So that stays the same. How we trade markets, we're all electronic. There's a lot more traders now, so they're a little more emotional. That's a change, but not the core fundamentals. Those haven't changed.
Let me shift gears on you again. Since you've seen everything, so I'm just going to keep asking questions. So in the last couple of years, and I had a hedge fund buddy of mine call me recently, and he was having a conversation with a fund manager friend of his, and they were talking about volumes in Chicago, and they were talking about MF Global, and they were talking about a VIX, at least until the last month or so, has been non-existent. And they were also talking about London, and they were talking about funds, big U.S. funds moving offshore, and Dodd-Frank and QE. So is there something structurally going on that maybe has kind of come out of the two-headed monster of MF Global and current QE policy that is possibly changing the structure or the trust in the markets, the commodity markets that you've known since you're a young man?
Yeah, the trust is, I think, the big thing. The EDF Man fiasco, and then Russ Wassendorf. That's another great fiasco where the regulatory people won't take responsibility for not regulating who they should have. A lot of people are going, the commodities are as risky as I was told they were. And so I think we've dried up some of that. There's been some shrinkage, but there's been this whole expansion of the Forex or FX market. And that actually concerns me a great deal because so many Forex people are saying you can open an account with a credit card. You only need $200 to trade, and we'll give you 100-to-1 margin. I have more respect for people selling crack cocaine on a street corner than somebody's going to give you 100-to-1 margin. And it's ridiculous. 100-to-1 margin, you're going to lose all your money at some point. It's just a question of time, this day or tomorrow.
And so we have IRS agents chasing you down, but the 100-to-1 FX margin guys, as long as I can remember, have been promoting that as a legitimate investing type opportunity, and the regulators just stare in other directions, I guess.
Yeah, well, and I think they're changing it now. You can only offer 50-to-1 or something like that, but it's all ridiculous. Like, oh my gosh, and your commission is higher there than it is in the Globex or the ICE. So, but it's all a promotional thing. And I guess that's another thing that never changes. You always have these guys out there. You always have humans are greedy and want to make a lot of money, and you have guys who will pander to that, whether it's internet marketing or whether it's Forex or commodity trading or stock investing. There's always somebody there to indicate maybe you can make money quickly. You can raise red worms in your backyard and sell them to fishermen. There's always somebody with a deal for you.
Indicators, something that is near and dear to you, and many indicators with your name affixed to them. I think a lot of people starting out in the markets, when they first learn of technical analysis or trend type trading, they see these indicators, they get excited. And once they get what it is, and then the next thing you know, you've got a chart that looks like hieroglyphics on there. There's so many things going on that it's just destined to not work, but they don't necessarily see that. Why don't you talk about the idea of KISS, keeping it simple, stupid, so to speak?
Well, I think it's really important that because all these indicators are really redundant. For the most part, if you look at the Bollinger Bands percentage or Williams% or RSI or stochastic, they all look almost exactly the same. I've done presentations on this. There's not an ounce bit of difference worth between them. Yet guys will have all these indicators or gals on their screens, and they're just redundant. And they are actually redundant of price because they're based on price. When I took logic in college, my professor, Albert Castell, said you cannot predict A with A. You have to use B, C, or D to predict A, but we're using price to predict price. And there are some aspects of price maybe we can look at that are helpful, but there's so many indicators that you don't know what to say. So I think you need to break down your indicators into a couple categories: the fundamental ones, the emotional ones, and the trend ones. And then whittle those down to as few of those as possible. Then you have a sensible approach. I only, on my charts, I have 3-4 indicators on my charts. That's it.
Yeah, I think for some new traders starting out, that might seem foreign, but I think it's good for them to hear simplicity.
Well, there's no perfect indicator. I mean, I've got some really great indicators, and they don't work a lot of the times.
Yeah,
they work often enough, but you just because somebody, as you know, people will show indicators in books. And in an uptrending market, all this stuff works, but markets don't always trend, and they never show in the books the bad aspects of this stuff. So everything looks perfect, and then you start trading it, and you run into reality that actually a divergence in an oscillator may be very bullish, but the books say it's very bearish. So you got to be so careful, as Ronald Reagan said: trust but verify.
Yes, and I actually he said that in regards to Gorbachev, did he not?
Yes, yeah, in Russia, yeah.
I had a chance to meet Gorbachev once. That was interesting.
Oh, how cool!
Yeah. Well, let me. I want to kind of wind down with you and maybe talk a little bit, because I want to get some of your perspective, big picture. Look, we're going to go ahead and give your website address and where everybody can reach out to you. But I think ultimately, some of the most important aspects of being a trader, an entrepreneur, somebody that just wants to get ahead, there's just certain personal ways that make a lot of sense to be. And I know clearly by your bio, you've been a fighter. You've definitely fought fights. I'm curious, when you look back in hindsight, do you Do you regret any of your fights, or do you feel like those fights shaped you and gave you wisdom today by going through those experiences?
Oh, I'm certain there's one or two I would regret. I can't recall them. But I think that the temperament of the Montana idea of, if you're right, you stand up for it. And if you get beat up, so what? You stood up for what you believed in. And I think that actually helps in trading because you're willing to take a position. A namby-pamby guy who will run from a fight won't take a position in the market. Paul Tudor Jones was a boxer. So many of these traders have been in an aggressive form of something along the way. Charlie DeFrancesco, the largest bond trader in the history of the world, was a great football player. I was a mediocre football player in college. He was great. And I think that aggressiveness maybe, or that willing to take a position, not aggressiveness, willing to say, yeah, I'm in, I think is actually helpful to trading. That's how I see it, at least.
Well, you mentioned earlier, and I didn't get a chance, I didn't follow up on it, but you mentioned the idea of Montana and the bucking bronco. And I was thinking to the big city kid, or frankly, even worse, the suburban kid, the suburban fast food kid. But here you grow up in Montana, the idea of a bucking bronco, by its very nature, is you are going to get tossed off. And you're actually, you're judged by getting back on. And I think in a society these days where every headline is, or it seems like a lot of headlines are banning dodgeball. I saw a headline the other day, a little kid apparently, and I'm not condoning any kind of violence, but I did this as a kid. All little boys do this. He held up his hand. He made like a gun symbol. He was like 7 years old, and they suspended him for school for a year. And I think there is I think there's a neutering of society going on, Larry. That's frankly frightening. Like what is happening to us that we think everything is supposed to go in a straight line, and everybody is wearing like some kind of padded suit, and there could be no injury. Doesn't injury teach us something?
Yeah, I couldn't agree more with that. That we've tried to have this pasteurized, homogenized society where everybody knows what's best for us. And even if they're right, we never really learn it on our own. I mean, you can read something in a book, but until you experience it, you don't really know it. So, yeah, to get tossed off a horse or get tossed off a bike or a car, or do stupid things as I did, as I'm certain you did, as we all do, that was a phenomenal learning experience. And we don't get that much anymore because we're protected. That's a societal change that we're trying to transition through on part of some political people, and the other people are resisting it. That the best learning is from your experience. And certainly Michael Bloomberg saying you can't have a large Slurpee. I mean, come on, Michael. That people will actually rebel at that and have more of them, or they'll order 2 or 3 large Cokes instead of where they would have just had one. So, yeah, it's sad to see. And I think that may be why more people are coming into trading. I've seen really 2 interesting things. People do want some place where there is some exposure to risk and opportunity. And it used to be when I lectured on commodities around America in, say, the 60s and the 70s, it was all middle-aged white male. And about 1980, that started to change, and the people coming in were younger, some female, still not very many, and a lot of first-generation Americans from Germany, from Italy, from India, from Mexico. Suddenly there was a shift. The risk-takers in America were no longer Americans. They were first-generation new Americans. They were the ones that wanted to risk. And that really just was a real wake-up call, like, wow, the people that want to risk are the new generation, not the old generation. You still see a lot of that.
Yeah. You were mentioning about silly things in the youth, and I was just recalling that one of my favorite experiences growing up, I was probably 19, was waking up the next morning and having 2 black eyes, not one, but having 2. And that actually, I don't know how many guys can actually say they woke up and had 2, which means I didn't win, but I learned a lot. And I did hurt one guy at the bottom of the pile. But I was just on a really kind of a more simple level. I should tell you about crossing the street in Saigon. So it's a city of 10 million people. There's 5 million motorbikes. When you cross the street in Saigon, you look left, you look right. You look left, you look straight. You look right, you look left again. You look right. You don't ever stop looking. The risk doesn't stop. And I think that's kind of what you're getting at, is that maybe there's a desire for people kind of, there's a certain segment of the population realizes that frankly, the nanny state is not fun. It's not fun to be put into a padded uniform.
Yeah, all gray is not a pretty color. Sounds like a great place to raise commodity traders. You got to look and be aware of that much.
Look, and I've mentioned this on some of my other podcasts. I was speaking earlier this spring in mainland China, and I have to tell you, sometimes people think that Westerners will say about the Chinese, their religion is money. I can report with firsthand experience, the mainland Chinese tell you that their religion is money. They don't beat around. I mean, they say we are going for it.
Yeah, it's certainly changed. I was first in China in the late 1970s, and everybody that was there wanted me to bring them home to America. And now, when I go to China, I've had 3 or 4 books in Chinese. They want to buy a house from me and have me come live there. I spoke at their Stanford unit, their comparable Stanford lecture there. It's totally changed now that it's opened up, and they really are about making money, which really means they want more freedom, because that's what money buys you ultimately, is freedom, nicer lifestyle, a freedom to live a nicer lifestyle. And they really want that, and they are working so hard for it.
Yeah.
It's, amazing opportunities there.
I remember walking down the street this spring, and I passed a basketball court, outdoor court, and there was a bunch of young guys, probably 17 to 22, playing hoops. And I mean, these guys were 6'1", 6'4", all wearing sweatpants, running around dunking. And I was thinking to myself, I don't think a lot of Americans realize that they're handing out milk and meat here these days. And I would tell the Chinese, I said, I said, you guys remind me a lot, and some of these speeches, you remind me a lot of Americans, because in America, American likes to everyone say, hey, we're number one. Well, I'll tell you what, the Chinese view themselves as number one too. And anybody that thinks that it's just an American playing field and it's not global today, I don't know how to convince you.
Well, yeah, that's a great point. It has become more global. And I think in part because America, part of our leadership is backed away from wanting to be number one. We don't want to be number one. We certainly don't have a policy of that anymore. It's, well, we have to be fair to everybody, and we've been a colonialist all these years, and we shouldn't be number one. Like, what a stupid attitude. I mean, I don't care if you're Taiwanese or you're a Singaporean or an Indian, your country should be number one for you. You have a right to earn that position. And for some reason, so many people here have just backed off from that.
Yeah, it's interesting. It's interesting that we're talking today with some of your political background, and I had caught some this morning that they were having the great political debates in D.C. about debt ceilings and whatnot. And let me end up with that. Let me let you kind of describe, if you're willing, how do you see? And I think your politics these days is mostly libertarian. Is that correct?
Very correct.
So if you were to give advice to somebody, and because look, I know that if I say the word libertarian, which is where I kind of think of myself, most people will kind of in America give you kind of a slanted eye, like, well, what's that? And still, but why do you consider yourself libertarian, and what are the advantages for you philosophically? How did you get to that point? I know I've covered a lot of ground today, Larry, but you got a lot of experiences. I'm sorry I'm going everywhere.
No, that's fine. It's made it enjoyable. I got to that point because I was tired of seeing politics of either persuasion having a Band-Aid philosophy. Oh, there's a problem, we'll put this Band-Aid on it, which is usually more money. But there was no thinking or theory behind why these things were done. Libertarians, whether you agree with them or not, they are consistent in their approach to government. I've known Ron Paul for 35 years. His views today are the same views he had 35 years ago. He is consistent. And I may or may not agree with him on everything, but I know exactly what I'm getting with him. I don't know exactly what I'm getting with most Republicans and most Democrats, because they're all over the board. It's whatever panders to people that are going to vote for them or give them money. That's the driving force of their political theory. And I really like to see some consistency in government, and how we need government. We need it to do certain functions, and it just needs to be done on a consistent basis. So we understand the limitations of government, as we've talked about earlier, and the greatness of government. And I think that's what libertarians offer is consistency. Might disagree with them, but you know where they're going to stand on the issues.
Yeah, I couldn't agree more. Hey, Larry, where can the audience, and obviously the audience is going to already know where to find you, but where is the best place for them to go connect with you? Your website, your Twitter, Facebook, where do you want people to best be directed?
Well, at 71 years of age, I don't want any more friends. I'm trying to lose some of the ones I have right now. So I have no Twitter.
You don't hold on. Does that mean you don't want anyone showing up at the Virgin Islands, knocking your door and saying they're going to take you to lunch? You don't want any of that?
We've had that happen. But the best place is our website, ireallytrade.com, because even as an old man, I still really trade. So ireallytrade.com. There's a lot of stuff there, a lot of free stuff, and we're not much into marketing anymore, but that's the best place to reach me.
Okay. Well, how is the? Well, I've been to St. Thomas, but
I can see it across out of my window. I can see St. Thomas today.
How's the weather today?
The weather's beautiful. We kind of live in perpetual summer. The tax code here is so great. If you qualify, your state, federal, and local tax is 4%. It's at 3.9. We call it 4%. So there's a lot of traders that have moved here, publishers that moved here, a lot of software companies, because 4% state and federal tax is a heck of an advantage. So it's an interesting community. Yeah,
I was down a couple years ago speaking with some guys that had set up shop down there. Yeah, it's definitely interesting. Well, listen, Larry, it was great. I appreciate you coming on today and offering all kinds of perspective.
Well, I am honored to be on your show, Michael. Thank you so very much for having me.
Well, I appreciate it. Look, people. I think it helps so many people to hear. I mean, they can always hear me rambling on about whatever, but I think when they hear different perspectives, people that have led interesting lives, people that have taken chances, take risks, it can only help other people to say, hey, hold on, I don't have to just sit in an office cube for my whole life. I can go do something. And so I think you've definitely done a lot of different experiences, and I hope people learn from that.
I hope so too. And that is a wonderful thing about trading, is the lifestyle that it can create. If you want to make a big business out of it, like some of the guys we've mentioned, or you want to be like I am, kind of a free spirit, do a bunch of crazy things, you can do that. It leaves the canvas wide open for you to paint the picture, because you have control of your life as a successful trader, not a boss, not a company.
Yeah. Larry, once again, thank you. Hopefully we will talk again on the podcast.
I look forward to that. Thanks very much.
And finally, to sign off today, the reclusive, but very interesting, very astute, very successful, Toby Crable.
Hi, Mike. How are you?
Man, it's been a long time. I think it could be 9 years since we spoke.
I think that's right. I think it was in the Virgin Islands, right?
Yeah, I was like, wow, where's time go? That's really scary.
It's a bit frightening.
Right. I just hope they figure out this life extension soon before we leave. So.
Yeah. Interview Ray Kurzweil. I think he's after it. So.
Yeah. So how's it going?
It's okay. I keep working at it and improving a little bit incrementally. And those little gains help. So that the firm's going well. My family's good. And we fully moved out from Wisconsin, and it's a good life, playing a lot of tennis, and there's a lot of good things happening here.
Let me jump into the setup of tennis, but first I want to describe a few big picture points. I want to drive right into what you just mentioned. So the head of Crable Capital, over $1 billion assets under management. Since 1992, your track record starts, but not an overnight success story. And I just checked on Amazon today to look at your book, Day Trading with Short-Term Price Patterns, priced at $981 for a new copy.
But a little low.
So, but here's where I want to go though. Before all of this, pro tennis player, I think you got as high as 280, or as low, I should say, 280 in the world. Talk to me about, though, that experience of being such a competitive tennis player, the 8 hours a day for years practicing.
Is there a direct translation to the competitive drive that you have in the asset management field, the fund management field?
I think a direct translation, actually. I mean, I refer to it all the time as it's an analogy for what I'm doing in my business and the way I approach things. So, especially in those early years of the track record, but it can be a good training ground if you take away from it the idea that we can always get better and we can improve at what we're doing, and the one thing that's very clear is that there's losing days, and there's losing trades, and there's losing tennis matches, and how that's handled and what you take away from it is the most important thing. So that's I think for me is the key to longevity, and the solace that I haven't always done that very well. I mean, in tennis, I think I stopped a little early. I had looking at the record, I had a lot more potential than I gave myself credit for. So one of the things I take away from that first career is that I'm not going to quit. So that's why, I mean, there's been some tough times in these markets and in my own business, and I just don't. First of all, I don't want to destroy anything that I have by having too big a drawdown. So we're very conservative with risk, and I think that permeates the firm. And then secondly, when you're there to fight for another day, you don't let yourself get overwhelmed by the tough times, the losses, the day-to-day grind of it. You try to elevate a little bit and keep my head about me when it comes to that.
I'm guessing from a tennis analogy, if we're going to stay there for just a moment, you would probably prefer the consistency of a track record. If I pull up Wikipedia and I look at Federer versus a Nadal. Nadal is fantastic, but he doesn't have, best that I can tell, the consistency is just, Federer's in a completely different league.
Yeah, I truly do admire, of course, both players, but Federer's, it's just incredible talent. But the way he plays, there's a conservation there of energy, I think, that will allow him to play, I think probably we'll see a lot longer than a lot of players. And there were others like that in the history of the game. I mean, Ken Rosewall played into his 40s and did very, very well. It doesn't happen as much anymore, but, I can think of Pancho Gonzalez was in his 40s when I think he did very well at Wimbledon one year. So, I mean, if you're, I don't know if it's pacing yourself, but Nadal's passion is fantastic. You have to love the intensity that he brings to the game, and there's really something really important about that when you see it. But yeah, I mean, when I think of my careers, especially this one, I'm thinking lifelong. This is something that I really enjoy, and I'm just fascinated by markets and price movement and how to quantify that. It's my science. It's what I do. And there's hardly, I mean, you can train in other sciences and that'll help, but you got to really get in there and work with the market data and use your imagination. So yeah, this is a lifelong pursuit, Mike, and I think that I don't think I'd have it any other way. I'm not going anywhere.
Let me drive into this. So I want to break apart some trading aspects and details of how you approach the markets philosophically, et cetera. But I know when we talked years ago, you really thought that your space, and we had a nice long conversation comparing your style of trading to trend following, some of the quant trend following, and there were some commonalities, but your time frame was very different, and you painted a picture that you were in a pretty unique space, that you were very humble about it, but you were saying it was very difficult to compete with your strategies. Whereas there definitely are, many more trend following traders out there, and still to this day. So I'm curious, do you still feel like you have this unique space, your firm, and its multiple strategies?
I think so in the money management world, handling client capital. I think it is unique because most of the shops I think our evolution is we're moving shorter, and our holding periods are tending to be shorter. So with that lends itself to, there's only so much in the way of assets that you can manage, and there's a demand for it if you're good at it. So you have to be careful. And what happens is, I think there's some very good proprietary firms that have evolved into relatively short-term trading, like us, or shorter. And the high-frequency firms are certainly an example of this. I think that they're primarily, or almost exclusively, high-frequency are prop firms. So they're using their own money and investing that, and instead of trading client capital. And it's understandable because of the capacity constraints that exist in the short-term area. But yes, it is unique because and it's certainly in the money management field. There aren't a lot of us. What we do is we're trading primarily liquid instruments or a liquid product for clients. We trade frequently. We're less than 1 day, and our holding period on average is a lot of turnover in the portfolio. It costs a lot. It costs a lot to run the business. There's huge challenges in the execution area. So we really, it's not an area that I think is just not that because of how it's prohibitive with the cost. It's just an expensive proposition. So there's not a lot of people that are going into this. So, but I came by it honestly. I worked with a floor trader in the early '80s. And we had a joint account, and his account, he paid no commission. So I was led by the nose to be trading and to take profits intraday. That just stuck with me over the years. That's just what appealed to me after doing that. You're kind of hooked. So yeah, it is a unique area in the money management field for sure. There's plenty of prop firms though that do this. And those are our true competitors, I think, when we think of where we're at on the planet. It's those prop firms that really stand out to us.
We spoke before. It was multiple diversified systems, applying them systematically across multiple different time frames. Where are you in your total number of systems these days?
Yeah, you can talk about the systems individually, and there's several thousand in the portfolio. Or you can talk about the ideas, which are broader conceptual frameworks that we work with. So, for instance, in my area of the portfolio that I oversee the strategies in particular, I'd say there's probably 25 conceptual frameworks that I'm working with there. And I think the rest of the portfolio managers in the firm think in the same way. So they have a broad conceptual framework, and then they apply it in particular with a strategy, and may even vary it slightly in the different markets because markets are different. The universals apply throughout all markets, but there are particular aspects of each market that you should probably take into account. So what I like to say is that the markets are the same in principle, but at the same time they're different. So we're dealing with two sort of different formulations of what markets are. Do you optimize for each market? Well, not heavily, but yeah, there are variations for each market, and that may count as an individual strategy. You see, so that's probably why the number is as high as it is.
You would like your models working across all markets, though. I mean, if that model works, you want it working at all markets.
When you're doing the testing, you want to see it apply universally, I think, across all markets without much variation. Actually, without any variation. So that's step one. After that, you may go in there and take a closer look at it. Because one example clearly is that there's a lunch hour in Asia in the Hang Seng. I think the Hang Seng takes off for like an hour and they go to lunch. If you're going to trade that, you have to account for it. It's almost like a new opening, the second round. When they come back from lunch, it's starting fresh. Back in the day when I wrote Opening Range Breakout, I don't know if I took that into account. It may be something to take into account. Have 2 openings a day in the Hang Seng market. Well, that's a unique sort of construct. You have to take those kind of things into consideration. But the general principles apply. That's certainly what I've seen and tried to adhere to, is that because that's a more robust framework than when you're building these portfolios. There's not any clear-cut statistics that tell you what it is you're supposed to be doing with a strategy. There's just not that much insight in the stats. But what you do know is that if you can find something, a widget that can be applied in sort of a universal, general way, then you have something that's really, really powerful.
The phraseology you'd used years ago with me was a kind of an assembly line thinking is what you were, that automation and being able to apply it religiously.
Yeah, that's it's an appealing way of looking at it. Sometimes it really. I think what it does is it keeps you honest when you're applying these strategies. So that's very important.
So Toby, when you're talking with clients, or you get the random elevator pitch, but you probably don't get too many of those, or you have to give the random elevator pitch, people want to know, where did the profits come from for Crable Capital Management? So, you've got counter trend strategies, you have momentum style strategies, you probably have others that I don't know about, but where philosophically do you see those profits coming from? Why are you able to extricate those profits from these liquid markets, liquid futures markets, et cetera?
Well, I think when we're successful, what we're trying to do is find areas where it's very difficult for participants to act. Places where there's market price action that aren't comfortable places for a human being to trade in the way that we're trading. And those seem to be the most profitable. And if you're a discretionary trader and you're doing that, either you're rewiring your sort of innate psychological disposition in order to do that sort of thing, or the fast track to this is to quantify it and then just let the machine do the work. But over time, a discretionary trader, going against his nature, fear, greed, it will wear down, because it's traumatic in a way. And that's where the automation is a real help. You need, in order to get an edge, you need to do something that essentially nobody else can feel comfortable doing. I mean, there's got to be some people, but you may be the first, or you're very early on. So the recognition of that requires a little getting ahead of it a little bit. Seeing the market work itself into a position where it's vulnerable to sort of weak thinking that can take place, because we are vulnerable as humans. That may be too philosophical, but the problem, you don't want crowded trades. You want to be there when it's very difficult for other traders to operate. And that's sort of the wonder of systematic trading, I think. It's a real benefit. But that said, we tend to try to find the times when it's right to go against price action. And then, as my early work would suggest, I also was looking for times when the market is ready to move directionally in any given, day, and isolate those environments. That's an interesting area of work. The markets are different at different points, and that has to be taken into account. You have to. It's almost as if there's two separate, but there's more than that. There's many different environments, but traditionally our portfolios have been separated into at least two primary areas of mean reversion and momentum. It's our job to find out when it's right to do that.
You've not strayed from price action. I mean, your firm is price action at its foundation.
Yeah, and everything else that kind of goes along with that. I mean, volatility and volume, and there's other factors I think that are primary in that. But price action is a starting point. Price is a starting point. It makes it easy too. I mean, you get a lot from just looking at price alone. There's a lot there.
Talk about volatility since you bring it up, and I think everybody knows in the last month or two, we've seen some significant volatility across the board. And volatility is something, and a little bit of chaos, a little bit of markets starting to have that enthusiasm. That's not something, that's not a negative for your firm.
Well, it depends. There's winning and losing volatility. We prefer the winning volatility. At this point, what we have seen is this, and then it's changed a lot of things in our firm. That up till a few months ago, the volatility was at record lows in most of the markets. Foreign exchange market, the interest rate markets, even the stock market as it was rallying was on relatively narrow trade day to day. And so the volatility, the VIX was at a very, very low level until just recently. But with the foreign exchange markets perking up in the last couple of months, literally in most of the foreign exchange markets, euro currency, dollar yen, you had the lowest volatility range that I've seen since I've started trading, and those were relatively good markets for us to trade in the past. If the volatility gets too low, there's no movement, there's nothing to really take advantage of. You need price movement. What's happened though is all of the markets, starting with foreign exchange a couple months ago, have changed, and the volatility has increased at least doubled, which is a welcome to what we need, and for profitability we need price movement. Now the other thing, of course, we need is volume, and of concern is what happened in the last week or so with a lot of the markets. When you had these very large price moves, the volume dried up significantly, and we haven't really seen that. That's a new phenomenon. It's sort of this early in a cycle of volatility. It's sort of a unique circumstance, which leaves a question mark for me as we go forward in the thinking that we're doing about allocations and the kind of risk that we may have in the market. So that's another story. But the volatility has increased. It took a long time. I don't think this is going away. As markets contract like they did for as long a period as they did, it's my opinion that the volatility cycle is on the rise rather than declining in most markets. So something's up, in my opinion. Economically, I don't know what that is. I do suspect that with the amount of intervention that's taken place in the markets over the years by some of the governments, that the U.S. in particular, it's created a circumstance that can end up being very volatile, in my opinion.
Let me interject real quick there, because I think this is something central to your firm, and we talked about this when we first spoke, is the idea of shocks. And, when these volatile situations start, we can think back to the summer of 2007. It was almost foreshadowed what came into 2008. Now, of course, I'm not trying to make a prediction or anything. I'm just talking. But the idea of shocks, rubber band snaps, this is something you think about all the time. You're prepared for it. And you knew as a young man, and you saw this happen to other people, you did not want you didn't want to risk your career on price shocks.
Yeah, that's the truth. Well, we still have occasional bumps in the portfolio that certainly cause some sleepless nights. The clients have a certain appetite for drawdowns, and if you're within the range that you propose, and if you can adhere to that, you're in good shape. You're doing what you say you're going to do, and that's very, very important when you're endearing trust in a program like ours. So, but yeah, price. I think we could say just in this last week we've had something of a price shock, every time you see those, you understand where your weaknesses are thoroughly. So that's an area of it. It's a learning. If you can continue trading through that and you're okay, you haven't had a huge drawdown or, hurt your clients very badly, you've learned something. And there are things that you can put into place that will protect you further from these kind of things and these kind of events. And then, of course, you try to think ahead at what can create real problems for the portfolio. But it takes a really thorough knowledge of what's in there and how the portfolios evolve. And there's a lot of production going on in our company, a lot of strategy development, and you have to stay on top of that and really understand what it is that people are implementing in the portfolio, and so to truly understand your risk. But that is it. Look, if I'm building a 50-year track record, and I'm almost halfway there on this, which is a goal of mine, you have to be able to get through those price shocks. Those are the things that are lurking out there that can thoroughly put you out of business. And you're right. I have seen it before. It could be terrifying.
You started your career as a guy with higher drawdowns, much higher drawdowns.
Mm-hmm.
So you've changed that. I mean, like a complete opposite side of the coin. I mean, you've gone from high drawdown to, I think I was looking today, between a max of, let's say, 15 to 16% on your big portfolio.
Yeah, and it's been a long time since we've seen that. That's a pretty big drawdown. I think we're right. That would be a big drawdown now. So, hopefully our risk-adjusted return is improving. But when I was trading at the beginning, I wasn't thinking about portfolio management, and I wasn't really tuned into what a client would want from a portfolio. So risk-adjusted return has become the primary benchmark measurement for our firm. So certainly we do want to have a consistent return, but a decent return, but we also want to do it in a way that, in a less chaotic way, than say the S&P, and its long only position in the S&P. We would think that we would be far, far better than that. Our drawdown should be less and our return should be higher, relatively speaking, than a lot of or any instruments out there. So we really want to be at the top of the risk-adjusted group in the hedge fund world.
I think you told me years ago it was, and you might be less today, but 0.02% risk per trade.
Yeah, I think it is less actually, because of the more strategies you have, the less you allocate to each one. But that's part of the risk reduction in itself. There's diversification and low correlation between strategies, and the more you can bring on that are truly not correlated, it seems like the better.
I'd love to pick your brain just for a second and pretend this is like an audience question. So the trader out there, the would-be investor, and they love their one market. Perhaps they're only fixate on one market, perhaps a currency or perhaps just one equity index. And then when they start to trade, they put these huge amounts of risk on. Maybe they could get 5, 10, 15%, perhaps more into this one market of their net worth. Why don't you talk about, I mean, you've been testing systems and looking at these things for decades. Just give the big picture out of the gate, why that's such a bad thing to do, to be fixated on the one market and to be extending yourself risk-wise. I mean, everyone should know instinctively if you start risking that amount, you can blow yourself out. A couple losing trades and you're gone. I mean, capital's not unlimited. Well,
there's the allure of the profit too on the other side of that. So it can be quite appealing. Visions of change of life and quality of life if you can hit it on that trade. That's a problem. There's a gambling element, gambling mentality that's leading that. But I think this is part of the evolution of any trader. When I started out, I traded, you trade one market with one strategy, if that. You have a partial strategy undeveloped. So, but as I moved along, what I've done is I've broadened out that and tried to diversify through different markets and strategies. And we're still doing it. And I think we're trading 300 markets now, which is much more than I think when we last talked. That's 300 futures markets and foreign exchange. So, equities presents a whole area of diversification if you do it right for us. For the beginning trader, though, I mean, if you can imagine a discretionary new trader, he doesn't have the knowledge base. He doesn't understand a lot of different strategies. He starts with one strategy. And I heard a quote from Richard Dennis. I think it was in one of the Market Wizards books, that at the beginning of your career, you should be trading the smallest or the least amount of capital on the line, because that's when your knowledge level is the lowest. And as you increase your knowledge base, you can increase your allocation. I think that pretty much says it all. So to a new trader, it should be a learning experiment at the outset. And if you're experimenting, you don't do it with a large amount of your capital. You do it with a very small amount, just maybe represented, or you don't do it with any capital. You just paper trade. But you evolve into a more complex trader if you can stay. Caveat on this is if you can stay in the game to learn. So you don't want to damage yourself. There's a lot of people who just drop by the wayside because they just cannot handle the loss if it's too big. Those traumatizing losses can take you out of the game. And if you're not in the game, you can't learn. So you want to stay in. You want to stay in the game. You do not want to risk so much that it just totally traumatizes you.
Was there a moment in your trading career where you felt like, wow, I'm at the point where I'm at the cliff and this could go drastically wrong? Or did you shift gears completely at some point in time and say, I'm just walking away from, we talked about having steeper drawdowns when you were younger. Is there any kind of moment that you could think back to, that kind of a revelation where you just said, wow, okay, I now know the direction. I see the space where I should be?
I think that when I went and worked Victor Niederhofer's shop, it was very, very clear to me. It was a sort of an integrating moment for me, because I could see the research platform that was the best I'd ever seen, bar none, and then it was a great team that was working there, and he had hired very, very well, and I was just happier than could be to be working there with someone like Victor. Now, Victor has different risk parameters on his trade. That's another story. But as far as a researcher and a market philosopher, I've never seen anything like Victor Niederhofer. He's an amazing man. And the fellows that work there, a lot of them I work with now. In fact, in my firm, we have 6 or 7 gentlemen that I had met back in the early 90s when I worked there. But whatever the 10 or 12 years, when I started in 1980 around the floors of the exchange, when I got to Victor's 12 years later, I had a pool of market knowledge that I'd kind of developed the hard way, and when I brought it into Victor's, it sort of came together for me. I felt confident that I could make something happen in the field. It wasn't that I wasn't profitable previously in the 80s, but it wasn't as consistent as I would have liked.
Might be a good time to interject just as a kind of a side note. And I know this a little bit about Victor's background too, enjoying the philosophy of objectivism. And I believe you do as well. Would you mind commenting on how that has affected your business life, your life in general, your entrepreneurial life?
Well, in the 80s, I think when I started trading, I just got off the tennis circuit. I played in Europe for a few years, played team tennis there. And my philosophy, my view of life was a little bit different, and I didn't really, objectivism, I came across what Atlas Shrugged in 1986 and read that, loved it. What it did for me was, and this is the marvelous thing about Rand's work, is it provides a very clear-cut moral code. In fact, the only one that I've really ever seen that supports what we do, capitalist behavior, the capitalist system. And so for an entrepreneur like myself, I really felt it was essential looking back on it, it was essential to have incorporated that in my life. It changed my thinking. It justified my actions. Markets are very, when you're around the exchanges, you kind of look at your fellow trader, say some of the guys that came off the floor. These are some rough and tumble fellows that were around the Chicago exchanges, and I almost, there were times when I wondered whether this was really what my calling should be. In fact, a couple of times in the 80s, I went and interviewed for jobs as a tennis pro, and thank God they didn't hire me because I may have been doing that. Of course, I would have found out quickly enough that probably wasn't what I wanted to do after all. When I ran across Ayn Rand's work, it was an integrating moment for me also, and it led me to Victor. Now, Victor has variations on his own position philosophically, and we all have our different views of things. Essentially, he was a free market thinker, and we met because of that, and plus he was a racket guy, and he liked tennis players, so that I went out and played tennis with him quite a bit at the beginning. It was an entry, along with my book. It was an entry into Victor Niederhofer's world. But those are huge, I think, very, very important moments for me. I can't say enough about it. It's still an important. You really can't justify, I don't think. It's very hard to. There's a lot of confusion, I think, philosophically, and look at the regulatory groups out there and the people clamoring the newest book on Flash Boys and the beatings that traders are taking at just about any level. And how do you combat that in any way without some sort of sound philosophical underpinning? And I think Rand's philosophy provides that. It's an excellent moral code, in my opinion. It's a sane moral code.
Let me add back just one little bit on Victor, and I think it's interesting that everyone can read the press accounts from the last 15 years and whatnot, and many of those ended up being negative. And of course, he runs a very popular site, and a lot of people contribute there. But I think what's interesting is how many notable traders cut their teeth there. I mean, his brother, for one, many others that you could name off. So it's really interesting how many people really gained a toehold and a foundation. You could argue that you guys in some ways were another version of Turtles, perhaps, just a completely different setup. But I mean, there's a lot of people that came from being around him to have great success.
Well, Richard Dennis, I think when he had his experiment on whether he could train traders out of, create traders out of nothing. He brought in the original Turtles, and I think that was fascinating. The one commonality is that they're quantitative. Victor was running a business. He needed to hire people, and what happened is that it was a quantitative shop primarily. You learned the ropes when you went in there. You were you work with the master. He was a powerful intellect when you worked with him. He was a professorial. He was tough. But he was a real teacher. Now, the Turtles, I don't know. I don't know as much about that. But as far as the fanfare around them, I think some of those guys have done very, very well. They have a lot of volatility in their portfolios. But they are generally all quantitative, and that's the real similarity. And you can teach quantitative work. It's something that is transferable, I think. Developing a portfolio is a little tougher. I know Victor never really taught portfolio development. I think Richard Dennis may have more. They diversified through many markets right at the outset, and I think that was some of the portfolio work that I do started with his allocation concepts that I drew from the readings and some of the turtles that did talk about it. So this basic allocation methods. It's a good starting point when you're allocating to a lot of different markets. But I'm lucky because I met a lot of these fellows. Monroe Trout was also came out of Niederhofer, which is probably of any of the graduates, he's the most successful. And we don't hear about him much anymore. He's theoretically retired, but he was brilliant and did a fantastic job of building a business.
Hold on. Theoretically retired.
Yeah, I don't know. I can't tell.
We'll leave it at that.
So anyway, he's a great example. But we have, like I said, we have 4 or 5 portfolio managers in our firm that all came out of Victor's, and some of the best, I think, other than Monroe or Roy. So it's rewarding. It's a great group to work with. It's a wonderful sort of intellectual environment that we have that I'm very comfortable with. When I first started, I was a little lonely. I missed the guys at Victor's because there was a camaraderie and a very interesting. It was an interesting group of guys, and luckily I've been able to bring them on as time has gone by.
Hey, Toby, you mentioned 300 futures contracts today, and I think since we've been talking some of the quant style at the longer time frame, trend following models, and some of the shorter term models. For example, some of the guys that you mentioned that you got to know from Victor Niederhofer's shop. Talk about I think there's another commonality there, which is the liquid futures markets. So many of the traders that everyone reads about and all the books, the Market Wizards books, futures trading. There was a tangible liquid. I mean, why don't you talk about futures trading for a second?
Well, I think it's the most liquid markets that we can trade, and I think that there's central clearing, there's objectivity. I think things are extremely visible. We can liquidate our positions very quickly if we need to. That's comforting, I think, to the clients. I think a lot of the best traders started there, or they gravitated towards these very, very liquid instruments, and their strategies were worked around very liquid trading instruments. And I think it's no mistake. I mean, I think you look at some of the most successful traders out there: Paul Jones, Louis Bacon, Monroe Trout.
The list goes on. Paul Jones, Bruce Kovner,
Jim Simons,
David Harding, everybody. Yeah,
they trade a lot of equities, but that's an evolution. I think they started with the futures markets in a lot of cases. So it's a great place to learn. It looks like there's opportunity there to a trader, I think, when they first enter the trading world.
You know, you're a pretty ambitious guy, Toby. We talked about that years back. Give some inspiration to people out there. I think sometimes people think that there's this tried and true method. There's this system that you can follow for life. If you just work for this guy, everything will happen. But as you've talked about in this conversation, it's not that. There's no straight line. There's no do this and you will win. But I think a lot of it, if anyone's listening to you, it's persistence. It's just drive. It's find that passion, find that calling, and stick to it, and know you're going to take body punches. You're going to take gut shots, and it's how you pick yourself up.
Well, yeah, and try not to get hit too hard. Stay in the game so you can learn. the learning process. Look, we're all going to make mistakes. One of the most important things for me is that I was very clear. I needed to learn. I needed to feel that I could develop and get better. So my market IQ could expand and improve, and my understanding of the business could expand, and I could get better at it. It wasn't a static place for me. I think that, and that's what has happened. I learned, and I think that we all do that. We have to know that at the beginning we don't have as much. We may be very, 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 very bright people that come to the markets. I can't tell you how many PhDs in the sciences are being hired now by these firms to come in and do research. We do it ourselves. We really look for scientists and people that have great quantitative skills. But without market knowledge, there's, they don't really have anything. So that has to be developed. And you have to be able. Mastery doesn't come in a year or two. It's a relatively long process. It seems like maybe a 10-year minimum anyway. If you're going to get to a point, by the way, I mentioned that I don't think I've mastered this quite yet. I still have more work to do.
Hold on, the 25-year track record says something. I'm not sure what, but it says something.
Yeah, it's not bad. But look, I think we're really just that idea of trying to improve. In order to do that, you have to be passionate about what you're doing. You really have to love your work. It is your passion. So without this sort of constant fascination with what the market is, for me in this area, I think it's true in any profession. You find what you love. And be thorough about that, and then you master it over time. And I really don't. There are certain limitations that we have on the planet. It's wonderful what we can do as human beings. I mean, we can actually get smarter by building our pool of knowledge, make better decisions through practice. I mean, trading isn't much different than hitting a combination of underspin and topspin backhands. You have to hit thousands of them, and you get better and better at it. That's what we do, and I think that it's sort of the human condition. And finding your passion and then mastering it, I think, is one of the highest levels of what we do, what we humans do on the planet. So it's. I hope that conveys.
No, it does. Listen, I appreciate you taking the time today. I could keep you all day and just keep chit-chatting about all kinds of stuff. I do have one kind of last, we could keep talking, but I have one last thing I really kind of would love to touch on. And you've talked a little bit about who you admire and some of mentors, and we talked a little bit about that. I'm curious, though, for people out there, trading, business, philosophy. Clearly, you have a very strong philosophical perspective. What books do you really admire? What have you loved to read over the decades?
Well, if it's about markets, I think you have to look at Jack Schwager's Market Wizard books. I think it gives you a great view of some really great traders. I think that's inspiring stuff. Reading about the highest levels of the profession. I think it's really, really important. It's the inspiration, that's the food you need to go forward. I have to say, Ayn Rand's work, I think, the introduction to the OPAR, I think they call it, or they have a general text on the objectivist philosophy that Leonard Peikoff edited and wrote, and it's a wonderful book, and I think it gives a very clear exposition of sort of the laissez-faire approach and the philosophy of objectivism, which I think is so helpful to anybody out there. What other books? Of course, Atlas Shrugged I thought was wonderful.
I'll interject one here as we're along this line of thinking. I'm calling you from Saigon today. So Vietnamese girlfriend, I bought her the other day. She speaks and reads English, but I bought her the Vietnamese version of the Fountainhead, and she went through it faster than lightning. She seemed to really enjoy it.
We have a winner there.
Yeah.
That's great. That's a great book.
If you get through the Fountainhead fast and you love it, I agree, right? Yeah.
Yeah. I would also recommend Victor Hugo's work. It's some of the most beautifully written stuff and inspiring things that I've ever read. So, but at any rate, that's all part of our mastery, is reading as much as we possibly can. It's something it may be a lost art, these days, but with all the electronic stuff.
I'll still take a physical book over a Kindle any day of the week. I don't mind searching for something on the Kindle. That's great, but I'd rather have I can read faster with a physical book. Everyone can, I would think.
You must be over 40.
Yes. Hey, Toby, listen, it was great chatting. Hopefully we can talk again in the future sometime. I'd love to have you back on. We could, I think people are just going to enjoy this conversation.
Sure. We'll do 10-year checkups if you want.
Well, I'm going to have to bring it lower than 10. We can't do that. It's too long.
I'll be here.
I know you love giving some good philosophical bents, though. So, hey, people can go to check out your firm at Crable.com, correct?
I believe that's right. Crable, something. Crable.
They'll figure it out. They'll figure it out.
They'll
figure it out. They'll figure it out.
It's not a solicitation.
No. I'm just informational purposes. So don't send any crazy things to Toby and all that kind of fun stuff. So
buy my next book.
Is one coming?
Yeah, I think I'm working on it. I've got a few years into it now, so it should. The former book will be an appendix in the new book. So and then it will be updated. But there's a whole storyline on that too. I think I will publish something down the road here. I'm working on it.
Cool. Awesome. Yeah. Hey, Toby, it was good chatting with you again. I appreciate you taking the time today.
Thanks, Mike.
Okay, take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.